Hit it.
It's Friday, January 15th, 2021, episode 114. I'm Patrick Ceresna.
And I'm Kevin Muir. This week, we welcome to the show Accelerate Capital's Julian Klymochko. We chat about the state of arbitrage and what the heck is going on with these SPACs. Then Morris Sachs joins us. We get to hear all about what he is thinking these days about the markets, but even more importantly, how much booze he is drinking. Then in Talking Charts, Patrick talks about the gong show that is the current state of the markets.
And this week in trading history, we go back to the Fed easing during the Great Depression. We end with our segments of No Stupid Questions and Skin in the Game. And folks, we might even drink some beers along the way, so stick around. We got a great show. Lena, hop on. What beer are we drinking this week?
Today we're drinking Niagara Osthouse Brewers, the Barn Raiser Country Ale.
Okay, so before we go and give us a little tidbit about this, Lena, this is again from my good buddy Andy, and the last one was a little bit of a dud, but one of our readers kindly said that was not the best beer from this house, and that I had to try the Barn Raiser. So I've gone back to the well, and I must say I like this one a lot better. Mm-hmm. This is a good beer. Why don't you read the little side blurb or whatever it is?
So the Barn Raiser Country Ale is a fresh, juicy American pale ale with bright hoppy aromatics of citrus, grapefruit, tangerine, and peach. Deep golden color with a touch of caramel malt sweetness to balance out the hop character. Finishing clean and crisp.
Nice.
This one's good. I like this one. Thank you very much, Andy. This is a good one. I'm a buyer. Okay,
So do your disclaimer, buddy.
Nothing in this podcast should be viewed as investment advice. Listeners should consult an investment professional before making any decisions regarding topics mentioned in the show. Side effects of too much huddle may include delta diarrhea, thirst trap theta, and I can't say this. I'm not very good. Tesla vululitis. I don't even know how to say that, which is the inflammation of the Tesla.
Oh my God.
I'm not a doctor. I wouldn't be able to say half the words.
All right. Let's get on with the interview.
It's our pleasure to welcome to the show Julian Klymochko. Julian is actually a fellow Winnipegger, so I've been looking forward to this. And not only that, he goes by the title, The Arbitrage King. So welcome to the show.
Thank you, Kevin. Pleasure to be here, and looking forward to getting into it today.
I actually listen to you on a regular basis. You have your own podcast, and I enjoy it quite tremendously. I don't know if it's just the fellow Winnipegger that I enjoy listening to, the kind of another Plains person, but it's something that's a lot of fun to listen to. What is it while we're kind of, what is the title of your podcast?
It's the Absolute Return Podcast.
The Absolute Return Podcast. So make sure you check it out. So let's listen. Let's get into it and learn a little bit about you, Julian. How did you go from, a prairie boy to a big, huge arbitrager?
Yeah, it's a good question. So born and raised, as you said, in Winnipeg, Manitoba, right in the middle of Canada, north of North Dakota for all the Americans out there. Went to school locally. I guess I could have pursued Ivy League or something of that nature, but I found in high school I could get very good grades, but I never really tried, to be honest. So, and my dream was to, after high school, move to go snowboarding and be like a snowboard bum. But unfortunately, or fortunately, I did unexpectedly get a fairly large scholarship, so decided to pursue university instead. So I went to University of Manitoba, initially studying engineering, and then as a child, never really had exposure to stocks. I wasn't like Warren Buffett buying stocks at 8 years old. Really didn't know what a stock was probably until I was late teens or maybe even like 19 or 20 years old. But when I discovered it, it really created this lifelong passion. And so when I was about 20 years old, started pursuing a business degree in finance as well. So my academic career finished with degrees in electrical engineering and business concentrated in finance. So I've always loved markets and I've always loved technology. Degrees kind of focused on both of those. Got recruited into an investment banking gig, which is a real blessing at the time because, from my school, we weren't necessarily a target school. So I was one of, 2 or 3 people selected to go into investment banking. So started out as an analyst focused on M&A, mergers and acquisitions. So got to get great insight and details into the deal process from an advisor's perspective and insider's perspective on the sell side. Did that for a couple of years. I've always been more of a risk taker, so I like investing from a principal perspective. So I left investment banking after a couple of years and went into a startup hedge fund firm. And our bread and butter strategy way back when, and this was probably 13 years ago, was closed-end fund arbitrage, which was a really awesome trade at the time. This was through the credit crisis when spreads really blew out, going long closed-end funds at a discount, shorting the underlying portfolio. So systematic arbitrage investment, which I've always liked and have continued to do to this day. And outside of closed-end fund arbitrage, expanded to merger arbitrage, risk arbitrage, been doing that for well over a decade now, and then started following the SPAC market, which was really nascent at the time in 2013. I remember building my first SPAC model in 2013, and I think there were 6 outstanding. And now we look today, there are more than 6 that IPO'd today. On the SPAC side, there are actually 10 that IPO'd, and there are 326 outstanding. So that market has really boomed over the past year. And so fast forward, at that firm, I became chief investment officer and PM and started my own arbitrage fund in January 2012, focused on M&A and SPACs and things of that nature. And then 2018, I left to start Accelerate, which had the mission to democratize alternative investments. It's a funny thing because going through the financial crisis, we had an arbitrage fund that had great returns. Positive in 2008, 2009 was one of the few funds actually positive that year through our arbitrage strategies. But it was only available for wealthy investors and institutional investors, and they were very happy and thankful with the performance. But I thought that everyday average investors, such as like my parents and where I came from, we're getting a raw deal. And when people would ask what I do for a living, I say, well, I make rich people richer. And it always been my goal to offer that to the people who most needed those strategies. It's like, if you're worth $50 million, you're not going to be hurt if you lose a bit of money. But the people who need the most help are those that aren't rich. Right. And so the focus on Accelerate was really democratizing alternatives and bringing these institutional caliber alternative investment strategies such as arbitrage, long short equity, etc., to everyday investors. And what we do at Accelerate is we offer alternative ETFs covering arbitrage, long short equity, buffered ETFs, and a number of other strategies. So that's where we're at now. And as you indicated, the Twitter moniker, the arbitrage king, which someone gave me, and it kind of stuck with it. And that's really what I'm passionate about. I've always been a deal junkie ever since 2006, and now I get to capitalize on that from the investment side and the principal side. I also have a kind of mini SPAC up in Canada that is doing a transaction as well. So that's the market that we're focused on these days on the SPAC side, just given it's one of the few asset classes that is growing tremendously. For example, last year around this time it was about 20 billion. Now it's 140 billion. So it's gone up 7x in 1 year. And when you have this nascent asset class, you've seen it in digital currencies as well, where they're just highly inefficient. If you're an investor, and this is advice I give to new investors, like, you want to, as Charlie Munger says, fish where the fish are. And so if you're like, analyzing Amazon and think you can generate alpha because you have some sort of, superior information or better at modeling it, that's kind of a stretch when you have, literally tens of thousands of analysts covering it. But I find the SPAC market is highly inefficient, and we can generate, great risk-adjusted returns just by having better information. And we do that by having, one of the most sophisticated models on the street and really following it and understanding it, which is pretty cool. So that kind of brings us to where I'm at today. Very active on Twitter and social media in terms of sharing our research and views and things that we come across in our full day jobs, which is just, following these markets closely and investing and really sharing it with investors bringing transparency to a market and innovation on the alternative side that really has been highly secretive and hasn't really evolved over the past 30 years.
Yeah. Do you ever get kind of pushback from your hedge fund brethren that say, what are you doing giving away the secret sauce?
No, not really.
No?
I mean, you figure I would, but who knows? Maybe they're just not online following it, or
That's right. So there's so
maybe
much
they've
there.
yet to discover it. Who knows?
So there's so much there to unpack. I want to start with just the 2008, 2009. You mentioned that you had a strategy that, managed to actually post gains in that tumultuous time. Why don't you walk us through kind of what the basis of that strategy was, how you accomplished that, and just kind of give us a little insights in terms of how you were able to negotiate those treacherous times.
Yeah, so it's a pretty phenomenal strategy at the time that's kind of gone the way of the dodo bird as markets evolve, which they always do. I mean, some tremendous opportunities go away. And so at the time, we were focused on closed-end fund arbitrage, specifically Canadian closed-end funds. Now, Canadian closed-end funds specifically offered a very unique feature that made them great as arbitrage vehicles because they offered an annual redemption at net asset value, meaning you can elect to redeem the closed-end fund for the underlying value of its holdings once per year. So at the time, there are literally hundreds of them in unit trust, which was a standard closed-end fund, and a really unique structure called split shares, which I think only existed in Canada. But what a split share was a closed-end fund that consisted of a preferred share aspect and a capital share aspect, where the preferred shares, say this closed-end fund owned a bunch of bank stocks, the preferred shares would be like first in the capital stack and get all the dividends, and the capital shares would basically be like a levered equity on the underlying portfolio. Because if the portfolio declined below the pref value, the capital shares would basically be worthless on an intrinsic value basis and then just have option value at that point. But I digress. The strategy was closed-end fund arbitrage, and we're buying these things at a discount. And during a credit crisis, liquidity crisis, many of these spreads widen out dramatically. And you could model out a closed-end funds, and by modeling out, I meant you track all the underlying holdings to get a live net asset value, similar to what an ETF market maker would do. But we're doing that on closed-end funds, and many of them were trading at 5 to 10% discount. So if you could buy a closed-end fund, short sell all the underlying holdings 6 months prior to its NAV redemption date at a 10% discount, then over 6 months, you're going to earn like a 20% annualized return. And, we just had a widely diversified portfolio of those opportunities, which was a pretty phenomenal trade. But the closed-end fund market, those were high fee products that were really killed off by the ETF. And so ETFs are just are much more attractive investment vehicles for investors because they're low fee, trade around NAV, etc. However, the closed-end fund has made a bit of a comeback in Canada with 2 recent Bitcoin closed-end funds. So it's an interesting vehicle, but those Bitcoin closed-end funds are trading at premiums to net asset value, so no real arbitrage opportunity there.
Actually, the biggest Bitcoin closed-end fund is actually the Grayscale.
Yeah,
and that's at a monster premium, and it's huge. So the Grayscale, you can actually buy the private placement and deliver in, and there's an arbitrage there. Have you looked at that? I know you're a little bit of a Bitcoin aficionado. So is that something that attracts you?
We've been looking at that as early as, I believe, late 2016, early 2017. And back at my old shop, we're like, how can we capitalize on this massive premium? Because I recall at the time it was closer to 100%, which to me was just screaming the tremendous demand. And at the time, you couldn't short sell GBTC. There were no Bitcoin futures or other way of hedging it in an effective fashion within a fund. Like you couldn't short sell physical Bitcoin at the time either. And so the only thing that I could think of was, well, let's just launch our own. And so I actually ended up launching the first Bitcoin fund in Canada in summer of 2017, which actually was the obviously the best performing fund of that year because caught a wicked bull market. So, I've been a fan of Bitcoin for nearly 5 years, and, I continue to be a fan and got a number of things going on in the Bitcoin space as well.
So let's talk about your transition to SPACs, because that's what's on a lot of people's minds. It's the whole rage. You mentioned that you modeled out the first one in 2013, and one of the things that I find interesting is actually the SPACs. When you go look at the big players in this, a lot of them are Canadians, Canadian institutions, Canadian dedicated ARB funds and things like that. First of all, what do you think attracts the Canadians to it more so than the rest of the world?
Yeah, it's a really interesting question, and it's funny dynamic because I think I've tweeted in the past that Canadians are the best at two things: hockey and arbitrage, and not much else. Not tooting my own horn, just paying respect to a number of other very smart and talented Canadian arbitrage funds, and it's just a community that's been around as long as I can remember. Probably, well, before my time, I started in the business probably about 13 years ago, but I think this community really developed in the late 90s, early 2000s, and has really spread such that you've always had this tremendous presence in arbitrage throughout Canada, like mostly in Toronto, also Montreal and Vancouver and Calgary, in that, really talented shops focused on arbitrage. And most of the most talented risk arbitrageurs have moved heavy into the SPAC arbitrage space just because the risk reward dynamics have just been absolutely phenomenal. So it's not surprising to see that.
So let's talk a little bit about that. And one of the things that risk arbitrage is that you're trying to make a little and risking a lot, meaning that you go out and you buy a stock that's getting taken over, earning that small spread. And if something goes wrong with the deal, you lose a lot because it's, the premium collapses. SPAC is almost the opposite in terms of you're risking a little to earn a lot.
Yep.
Was that what attracted you at first? And what do you think in terms of why the market was slow to figure this out?
Yeah, it's a good point. And, I've followed the market since about 2013. And at the time, it was very nascent, less than 10 SPACs outstanding. As I said, I recall probably around 6 at the time. And the way that we view risk arbitrage is, some people say picking up pennies in front of a steamroller, but I don't view that as that way at all. Like, you were trying to put together a well-diversified portfolio of uncorrelated investment opportunities where we're highly certain of the outcome within a short period of time. So I view it more analogous to, call it, investment grade or high yield fixed income investing, because you don't have a ton of upside when investing in credit. Although in arbitrage, you occasionally have deals that break, like in our database, which we've been tracking for over a decade. I think historically, around 6 to 7% of deals failed to be completed. However, on the upside, you do have overbids or improved offers and bidding wars, which provides upside exposure to the strategy. But as you indicated, SPAC arbitrage presents a different risk reward profile, which, at least in the current environment, I believe is more attractive. Because, for example, it's not really available in the market right now, but rewind 2 months ago, or even to early January, like literally 2 weeks ago, you could have bought, I believe when I looked, and I think I tweeted this on my Twitter feed about 2 weeks ago, there are at least 20 SPACs available that you could buy for below trust value, or what we call net asset value. And if we want to take just a couple minutes to explain how a SPAC works, and that will explain
Sure, go ahead.
the underlying arbitrage.
Yeah, sure. Walk us through it.
So SPAC stands for Special Purpose Acquisition Company, also known as a blank check company. And how they work is they go public by initial public offering, their own IPO, where they just raise a pool of cash. A sponsor will pursue a deal, and they have a limited time to do that, typically 2 years. And so the SPAC IPO will be, the average deal is a IPO of units at $10 per unit. Notice how I said units, not shares, because the unit consists of common shares plus typically a fraction of a warrant, generally like 1/3 or 1/2 of a warrant. Sometimes no warrants, sometimes a full warrant. And that's just like additional equity upside. And so the key aspect to SPAC arbitrage that makes it attractive to guys like me is that the SPAC has a limited amount of time to do a business combination. By that, I mean a merger with a private company. Generally 2 years, and if they don't get a deal done, then they liquidate. And when they do the IPO, say they raise $200 million, 100% of that capital, the $10 per unit or the $200 million, goes into trust, of which is invested in short-term treasuries. So basically the safest asset on earth, and it accrues interest. And if they haven't gotten a deal done within those 2 years, you get back your $10 plus accrued interest. Or the other scenario, they announce a business combination, and when it comes to time to allow shareholders to vote on that combination, they give you the option to redeem your shares at the $10 plus accrued interest. So we know as long as we're buying at $10 or below, that we have virtually no downside as long as we're not forced to sell in the meantime. So we really like the downside protection aspect to it. And there's really 3 scenarios how this trade can play out. Say you buy on the IPO at $10 per unit, you get the shares plus the warrants. 2 years go by, they don't get a deal done, and they liquidate, and you get, say, $10.05 back because treasury yields are super low these days. Your warrants expire worthless. That's kind of the worst case scenario if you're buying at the IPO. But nearly everyone gets a deal done these days. We haven't seen a liquidation in a very long time. In the next best situation, say the SPAC announces a business combination, it's a dud, the market hates it, it doesn't trade above the underlying cash value, you can just redeem your shares and they close the deal. You still have these warrants, and warrants just intrinsically, based off volatility and term, they have a lot of value. And those warrants can add 7 to 8% to an arbitrageur's return, even on a crummy deal. But what we see in the current environment is that a deal gets announced and there's tremendous upside optionality, i.e. new investors come in, bid the SPAC way up above its underlying $10 net asset value to pretty crazy prices these days. I mean, if you look at Chamath Palihapitiya's social capital vehicles, he recently announced a deal with like SoFi or Open Door, and you look at those stocks and they're trading up substantially. And I looked at the stat this morning, and there's roughly, I think, 55 current SPACs of the 326 outstanding. Actually, I'll get the exact number. 56 that have announced a business combination, not yet closed it. And they're trading at an average premium on a unit basis of 86% over their $10 net asset value. So on average, of these 56 SPACs that have announced a deal, they're trading at $18.86. And we've been buying these at $10. And the average business combination has been announced 10 months after the IPO. So you have this tremendous upside optionality with very limited risk on the downside, assuming that you buy at the right price. And you know, it's a risky strategy because, or when investors start paying large premiums for these deals, because then that introduces downside into the mix. And,
well, so that was going to be my next question. You've already kind of jumped ahead. I was going to say, as an arbitrageur, as it moves away from that $10 NAV where you can put it back to the company, it becomes increasingly risky. And I was wondering how you manage that. And, you know, does it end up being that your portfolio is filled with all sorts of SPACs that are trading at $20 that now, instead of them having almost no downside, have potentially a lot of downside?
Yeah, you know, that's a great question. And it really goes to portfolio management of this strategy and the current environment that we're in, because, you know, we went through a bit of a frenzy in the summer, and we keep track of the average SPAC common share NAV premium / discount, because last spring, I mean, they're all trading at discounts. And then in the summer, a bit of a craze, and the premium was fairly significant. And then late October, early November, they went down to about par. right? And presented pretty tremendous buying opportunities. But now SPACs are trading pretty much at an all-time high premium. So what we do, like we try to follow, or we do follow a very systematic process, and we're buying at or below net asset value, sometimes in the secondary market, but it's not available in the secondary market in the current market environment. So we are focused on IPOs, getting those IPO allocations at $10 per unit. And some of them right out of the gate start trading at a massive premium. For example, the SoftBank SPAC, it's called SVF Investment, IPO'd just 1 week ago and instantly traded to like a 32% premium. So units that we bought for $10 in a massively oversubscribed deal. So we got a relatively small allocation, but are now trading at, well above $13 pre-deal. So there's a lot baked into that. A lot of that upside optionality baked into the price. But as we've seen, is the average SPAC that announced a deal on a unit basis is at roughly an 88% premium. And some pop, most of them are popping in the current market environment. But that being said, yeah, we do have a number of SPACs at a premium, or at some point, many at a premium. And our process is to buy at or below NAV and wait until they do announce a business combination, and then seek to exit prior to closing. So we have a systematic selling program that we're running every week on SPACs that have announced deals. And this week we're probably selling close to 20 SPACs.
So you're just trickling them out there, like VWAPing them out or whatever,
yeah,
working them out.
Between announcement and closing, which is typically 3 months, and recycling that capital into new issues. For example, we did subscribe to 3 new SPAC issues today, which we're really excited about, at $10, and the ones we're cycling out of are probably around $20. And it's a systematic strategy that we're pursuing.
Okay, so now there's no doubt about it. The SPAC market has been completely hot. It's been the thing that's on everyone's lips. Everyone's talking about it. You just already alluded to it, that in the past you used to buy these things and get full fills, and they would probably trade around par, or maybe slightly up, and now it's just a gong show of bids. I'm trying to think through this and figure out who's losing, where the risks are, and I have some of my own ideas, but I just first would love to ask you, what do you worry about when you see this sort of frenzy, and what concerns you about this market?
Yeah, and so people got to realize that this market changes so quickly. Like, for example, year to date, and just in January, the SPAC IPO market has raised $13.7 billion. And the number of deals, there's been 53 SPAC IPOs. So that $13.7 billion exceeds the previously high annual toll of like $13.2 billion in 2019, which was a banner year until 2020, when total raise was about $82 billion. So, I mean, the bull market is continuing in SPAC issuance. And, it changes very dramatically, because if we rewind back to like late summer, in the fall, September, we were subscribing to IPOs heavily oversubscribed. And as deals get oversubscribed, what happens is you start increasing your orders, because if you're only going to get like 1/3 filled, then you're like, okay, I should boost my order to try to get a better fill. And then fills start getting 100% done. And then, at the time, I remember, this was probably October, every IPO we were subscribing to was trading down 1%. Like, we buy at $10, opens at $9.90, $9.85. We're like, ugh, this sucks, because we're losing money, or like day one on all of them. And that was only, call it 3-4 months ago. And so just to give you a sense, now I looked at the ones that we subscribed to, just say on the 13th we subscribed to, there were 6 SPAC IPOs. We subscribed to 3, and of these 6 SPAC IPOs, they're traded up to a 9.4% premium, which is just crazy in my opinion, because it changed so much dramatically from just 3 months ago. But the point I'm trying to make is this market changes very quickly. And I always caution investors, like, you never want to pay a massive premium for these pre-deal. That is a big risk that I see, and people are baking in pretty high expectations. And the other thing is And there's academic research to support that post-SPAC equity performance is not great. And so I would just want to define that term, because we define a SPAC as a blank check company that goes public, IPOs, and it loses its SPAC status and basically changes asset classes from SPAC to post-SPAC equity once they 2 days prior to the vote, because 2 days prior to the deal vote is when your redemption privilege expires. So when that redemption privilege expires, you no longer have like this embedded put on the stock, and it completely changes the risk reward dynamics, which is why we don't hang on to the common shares post redemption opportunity. And so from that point on, the security is now known as a post-SPAC equity and can just trade. I've seen some trade down to $2 very, very quickly. And post-SPAC equities follow somewhat of a Pareto distribution, meaning small number of winners and a large number of losers based on historical data. So, similar to what a VC firm might see. So on average, they've done actually quite well, but that's because you've had a few massive winners. For example, one like QuantumScape, which did an IPO through a SPAC at $10. Post-deal, it traded up as high as north of $100, and now it's at $54. So
Right.
Guys like us, we buy at $10 and we sell at $20 and think we're smart, but the retail we sold it to, or mutual fund or whoever, they wrote it up and now they're at $54. So, perhaps where the dumb money in there, there's smart money, but nonetheless, like where the SPAC market has been focused on in terms of business combinations are these early stage growth opportunities that are generally pre-profit and even often pre-revenue. And so you got to look at the market dynamic, and the current equity markets are really rewarding those, I'd say, glamour story stocks, not necessarily like the opposite of value stocks, right? We all know that growth and glamour and profitless companies have dominated returns for a long time, and that's really what the SPAC market is focused on. So a lot of these are trading at massive premiums on these, stories that are pretty far out in terms of generating revenue. I see many SPAC business combinations not going to generate revenue until 2025 or later at some point. So some of them are more so like concepts at this stage, which are incredibly volatile. Like when a SPAC announces a business combination, the volatility has been to the upside lately, but it can certainly be to the downside where, it can drop 20%. So these aren't like widows and orphan stock, especially after deal close.
I'd like to talk about that and get a little more into that, because I actually think that we're about to experience something that most investors in this space aren't aware of. And I think if you asked a lot of the new people that are tossing these things around and you explain to them that a SPAC could go down to $2 after trading at $10, and once the put disappears, it collapses 80%, they would tell you that you're insane and they would never believe that occurred. Yet it does occur. And I have seen the same thing. And I just want to kind of dive into that a little bit, because it doesn't seem like it's a very efficient market. And I guess to your point, it probably isn't an efficient market, and that's why it happens. But it's kind of amazing to me that, the days before we have this takeover of this private company, that people think that they're buying, shares in something that's worth $10. But the reality is it's getting held up by all the arbitrageurs like you.
Exactly.
That are doing that. And then what happens is, so it's almost like it's a false bid.
Yep.
And then once that false bid's gone, the true value of the SPAC comes through in terms of what the market is willing to pay, and you get this collapse.
Yep.
Would you agree that is, a good description of how that plays out?
Oh, certainly. You definitely nailed it there. And I've seen that dynamic for well over a decade, because we had the same thing happen in closed-end fund arbitrage. And so we'd be buying over time, tightening up the spread. And once you roll over the redemption date, our bid disappears. So people are selling into the void, and
Right.
it's down significantly. But it's just basically where are we going to bid for next year's annual redemption. However, with SPACs, and we occasionally buy to redeem on names that are trading at a discount prior to redemption, which we haven't seen in quite a while. I think the last one we did that on was Farpoint acquisition, FPAC into their Global Blue deal, which was a bit of a dud, and that's why I was at a discount. But one that I'd like to flag, for example, and I always tell investors that this is a strategy that's simple, not easy. It's simple in the concept, but operating it is very difficult. Requires a ton of knowledge, skill, deft modeling, a team to be following and trading and tracking all the IPOs, new issuances, and most important key dates like when are they filing the proxy, when are they stating the vote, when I got to have my redemption in, et cetera, because you wouldn't believe how many times I get calls or messages saying that, oh, I thought this was safe with a $10 floor, but I'm down 20% today and it's at $8. What gives? Like, well, you didn't properly keep track of the dates.
That's
and
right.
you rolled over the NAV redemption, and now it's trading, wherever it goes. And, that you're
So,
totally right in terms of like our bid is in the market, or guys like us, for example, is in the market up until the very last day of redemption. And then as soon like the next day when it disappears, that floor is completely gone. And I wanted to flag one SPAC that closed last year, Gordon Point acquisition. The ticker was GPAQ. They did a transaction with HOVF, Hall of Fame Resort. And last year it was at $10. And then it finished the year December 31st, traded down to $1.23 because it was a deal that was unsuccessful. But the SPAC was successful in closing it, but it was just a dud of a target. And
right.
one flag that really can show that investors that this may happen is if it's trading at a discount to its net asset value prior to the vote. Like that's
Right.
a easy signal to.
It's a huge warning sign. Like
Exactly.
if it's around NAV at the time of a vote, it's a warning sign that the market does not like it, and it's basically only being held in by you guys. But one of
But
the
like the crazy thing is that can actually change very quickly. Like I flagged one, and this was one of Chamath's vehicles, the one that did a deal with Clover Health. And initially, like Chamath SPACs always trade at a premium to NAV, had an initial pop up to about $13. But then, in the little SPAC correction that we had in late October, early November, it actually traded as low as like 987. And so that deal was like, quite the dud at the time. I'm like, well, this deal is a risk of failing, like being overwhelmed with redemptions or just immediately tanking upon closing. But I flagged to my Twitter followers is that, look, you can buy this right now at $9.95, and you have like a two-month option. If this deal turns around and sentiment changes and the stock could rally significantly, in worst case, redeem for $10. And then it rallied as high as nearly $17, $18, and now is at $13.55. So, it can be volatile in the meantime, but you're right. If right before the vote, it's at a discount, then there's a very good chance it's going to tank.
I think the other thing that a lot of people don't understand with SPACs is that until they actually go do the deal, there is really no market exposure, meaning they don't own anything. Yep. So as the prices of all these deals, let's just say the private market of the stocks that they're buying are increasing from more competition, what's happening is the SPACs are in essence paying up and doing deals at higher and higher valuations. And the question is, do we get a situation where they're paying more and more because there's more and more money in the SPAC until finally we get a point where they end up being dud after dud after dud? And that's kind of what I worry about.
Yeah, it's a really good question. And it's the same. You could make the same argument for the IPO market because, for example, like Affirm saw Airbnb go public and they're like, whoa, it doubled. This is crazy. And then Affirm, there's more than doubled too. Right. And, so you see that dynamic in IPOs as well. I think the one thing helping to anchor SPAC business combinations at reasonable valuations are pipe financings. And so the way that a pipe financing works, and these have been very popular these days, such that nearly every business combination we see announced comes with a pipe financing, a private investment in public equity, which is a concurrent financing, equity financing into the pro forma entity at $10 per share. So in order to get institutional investors, we often see firms like Wellington, Fidelity, or even industry players on industry specific deals. And these pipes are typically in the hundreds of millions of dollars. And you even see hedge funds get involved at that stage as well. That really helps anchor the valuation, because if the SPAC is underwriting a valuation that's significantly higher than institutional investors would support, then they just wouldn't get that pipe finance. Right?
It's almost like a rights offering with a backstop.
Yeah, exactly.
Right. Yeah. No, I get it. I just when I look at the SPAC market, I say, when something appears too good to be true, there's got to be a catch. There's got to be somebody that loses. It's like there's no free lunch. And so therefore there must be something that's inefficient, not inefficient, but there's always a little trick. And to me, the little trick is that what we talked about in terms of that you get fooled into believing that these companies are actually worth it in terms of the valuation, because there's a bid there from the SPAC arbitrageurs. And I truly do believe that once this market cools down, we're going to see a whole lot of these SPACs go to $10, and then the moment that put goes away, it gets crushed. Because let's just face it, it's so popular. There's a lot of crap coming to market. No?
Well, one thing that I would note is that you look at the data, and there's studies on post-SPAC equity performance, and it hasn't been great, specifically on a median basis where you have many underperforming. But one thing that I would note is that deals have really improved, as have sponsor quality. Like, I think one indication is the SoFi transaction. I mean, SoFi was a fairly high-profile company that, 2 years ago, you'd never see a company like that go public by a SPAC. You had these really small, companies that no one really cared about. But these days, you're seeing, significantly higher-profile companies, and a lot of the firms going public. I think a great signal or potential warning sign is Tesla. And so Tesla's stock is on market cap of roughly 700 billion. And, by all measures, it's kind of completely disconnected by fundamentals and more so driven off of its story. And a lot of SPACs are going after similar companies, because clearly there's investor demand for electric vehicle shares, as shown by Tesla's market capitalization. And those are the type of opportunities that the SPAC market is generating, just because there's so much demand for that supply. So it's not like the SPAC market would be independent of the stock market, because in the general market, you see it in the IPO market, you see it in the S&P 500 now. That is what the market is valuing, is these opportunities. So, if the SPAC market, the example that you cite, if that happened, then the S&P 500 would be getting crushed, because that, at the end of the day, that's what investors are rewarding these days, irrespective of if it's in a SPAC or not.
Yeah, I hear you. It's just another form of financing. So let's move on to the general market, and let's talk a little bit more about your firm. You mentioned that you were frustrated in making rich people richer, and the whole point of your firm was to democratize alternatives. Why don't you walk us through what you see as the challenges for individual investors and how you offer them, opportunities?
Yeah, I always thought it was crazy to just have all your net worth allocated to one asset class or two asset classes, like just equities or just the traditional portfolio 60-40. It's like, when you think about it, owning just two assets, that seems incredibly risky, in my opinion, and not diversified at all. So they say in investing, the only free lunch is diversification. And it's no wonder that you look at the average institutional portfolio, they own way more than just two asset classes, right? They'll own, private credit, they'll own market neutral, they'll own all these different asset classes, commodities, gold, et cetera, real assets, perhaps even digital assets. because they're trying to reduce risk. And the purpose of diversification is introducing independent return streams, i.e. uncorrelated return streams, into a portfolio with the goal of mitigating volatility and improving risk-adjusted returns. So I saw most investor portfolios, they didn't have those exposures. It's because there wasn't the opportunity ever to get those. You compare the average endowment portfolio, which I believe is 52% allocated to alternatives, and you look at the average retail portfolio, which is like 5% alternative investments. It's this massive divergence between the two. And so I just thought that that was pretty unfair. And I thought it was a great opportunity to be able to offer investors some of these strategies that family offices, endowments, pensions have been using for decades, but regular investors, or even call it like small pensions or smaller family offices, they haven't had the chance to invest in those types of opportunities. Like, say like an arbitrage fund has a $10 million minimum. Not a lot of family offices can meet that. So we offer an arbitrage ETF with no minimum. And there's other things that we're really trying to innovate and resolve pain points in the hedge fund space specifically. So looking at the hedge fund industry, it's $2 trillion. And looking at that opportunity and running a private hedge fund, like I ran private 2 and 20 hedge funds. So, 2 and 20 is the standard hedge fund fee. We were running that for accredited investors for, nearly a decade. And I found there's really 5 main pain points. So number one is there's such a pain to use, like all the paperwork you got to fill out, and you got to be an accredited investor. So it's really limited in terms of your distribution and as a business and who can actually invest in you. Then they're non-transparent. Many firms are highly secretive. You look at Renaissance Technologies, their clients don't actually know how they're investing their capital, which to me is just like mind-blowing. How can you give your money to someone and actually not know what's going on? Then they're illiquid. At the best of times, you can get your money back like once a month redemption, and hopefully get your money back 6 weeks later. So say you want to invest in a hedge fund, you might be invested 6 weeks later at best. And then lastly, the fees. There's just so many people sick of the 2 and 20. So I thought if we attacked those 5 main pain points, we'd really make it a significantly more investor-friendly vehicle, and really help more and more investors get exposure, help diversify their portfolios into different asset classes. So currently our flagship alternative ETF is our Accelerate Arbitrage Fund ETF, which is focused on SPAC and merger arbitrage. And a lot of people are resonating to that. You look at all the portfolios with allocations to fixed income, it's most investor portfolios, but what percentage of investor portfolios are allocated to arbitrage, which I think is an amazing strategy, and the track record speaks for itself. I think that the number of investors allocated to arbitrage is shockingly low, way too low, and my goal is to make it much higher. And we also have strategies that offer, we have our enhanced benchmark strategy, which is the index plus a long short overlay meant to buffer the downside and mitigate volatility. We have our systematic absolute return hedge fund. It's long short equity that is basically alternative risk premia, or these proven multi-factor models focused on various factors such as value, quality, momentum, etc. And we actually are launching a new ETF on January 27th, which we call the Accelerate One Choice Alternative Portfolio ETF. And we're pretty excited about that because it's an all-in-one alternative portfolio solution that provides exposure to 6 alternative asset classes, 10 alternative strategies, in an easy-to-use ETF. So really disrupting the fund-of-fund space, offering a Yale endowment-style asset allocation in a low-cost ETF that charges just 20 basis points. So we really like to innovate and do things first and bring institutional caliber strategies to the market that really hasn't been done before.
Well, that's fascinating stuff, Julian. It's been a pleasure having you on, telling us about your strategies and your life. Where can people find you if they want to learn more about you and your firm?
Sure. So you can check out our website, accelerateshares.com. We produce a ton of content on there, including our very popular SPAC monitors. We release our model on a monthly basis for anyone who wants to track all the 300 and something odd SPACs out there and provide some insights and commentary on the space, in addition to our M&A monitor and many, many other research pieces, blog pieces. We have our podcast, Absolute Return Podcast, put out 1 or 2 per week on that one. And then on social media, I'm fairly active on Twitter at Julian Klymochko, also known as the Arbitrage King. So check me out on that. I tweet usually focused on the arbitrage market, but then hedge fund stuff in general, also covering multi-factor long short investing and things of that nature, Bitcoin, et cetera, et cetera.
Well, thanks for joining us, Julian. It's a pleasure getting to know you.
Yeah, thank you so much, Kevin. Happy to be here.
It's our pleasure to welcome back to the show Morris Sachs. Morris, thanks for joining us.
Oh, it's great to be back. I always look forward to chatting with you.
This is going to be fun because the markets are definitely at a unique period in history. You have prepared some slides, which is very unusual for you.
I did. This is slides by Luddite, but we'll give it a try.
Let's give it a whirl, because it's actually an interesting collection of slides that you brought, because it's all over the map. It's not just, some charts. It's some things about human psychology and what's happening. Let's just start with the first one here. Yeah. This is a chart or a graph that you showed that talks about mental toll, the mental health toll that's being taken.
So let me just kind of tell you why I thought it would be fun to talk about this stuff today. If you look at many of the metrics that people value, let's say the stock market by, whether it's price earnings ratios, price to book, that kind of thing, distance from 200-day moving averages, everybody sort of agrees that the market is overbought, whether it's the amount of day traders, whether it's the huge surge in call buying, whether it's the put call ratios. I mean, any metric you look at, it's extended, right?
Right.
And so, I'm not a short-term stock market trader, but what I discovered a long time ago was when I started to pay attention to human psychology, mostly my own.
At the behest of your wife? I know that's how it is in our household, in my household.
She was very quick to point out areas of improvement. What they say, when mama's not happy, nobody's happy.
That's right.
But the point was that as I understood more about myself, I got to be a better trader. So you made a comment the other day, which I'd like to say you stole from me, which is, getting the calls is right. It's making money. That's the hard part, right?
Right. 100% agree.
Yeah. Okay. So anyway, I noticed that I had been drinking more. And that's, you can laugh, but I'm not a guy that drinks a lot. And
welcome to the Huddle.
Yeah, welcome to the Huddle.
It coincided with your first appearance on the Huddle.
Yeah, so I appreciate that. So, because we're in lockdown, I would call like the local Greenwich liquor store, which I had never done. And I said, I'm looking for a bottle of that. He says, it's kind of expensive. I said, well, I'll treat myself. And I said, do you mind delivering it? He goes, oh, no, be happy to. So the guy brings it up, and 2 or 3 weeks later, I call him up and I said, hey, what do you say you send up another one? He goes, be up there this afternoon, Mr. Sachs. And then a couple weeks later, I call, and he picks up the phone and says, good afternoon, Mr. Sachs. The usual?
You're like Norm in Cheers. Yeah. They start pouring the beer. As soon as you walk in, they start sending the wine or whatever it is as soon as you phone.
Exactly. So that was a little bit of an indication that maybe something was going on. So I had seen some of these screenshots from people like The Daily Shot or Breakfast with Dave, those kind of things. And also some stuff in some medical journals. And basically, unsurprisingly, and you can see this from this first chart, people aren't that happy.
Oh, yeah.
No shit, right?
Yeah.
Okay.
Yeah.
Okay.
But it's probably worse than we recognize and admit, I would say.
Yes. Now, obviously, that is a human concern. That is that's a huge issue. But what I'd like to talk about, since we're financial market guys, is this is a big deal because we both know that these Wall Street firms and analysts try and forecast what the economy is going to do.
Right.
And I've talked to a couple of them. And actually, one is a terrific economist that makes an appearance on your show from time to time.
Okay.
Excellent guest. And I asked them a couple of things. I said, number one, when you're modeling how the economy is going to look going forward, do you take into account any change in consumer behavior based on what they have experienced over the last 6, 9, 12 months?
Right.
And the answer is no. That they think that you got all this money sloshing around, and once people got the vaccine, it's going to be running around, shits and giggles, and life's going back to normal. And I mean, it might, but if we go to the next slide, I think what you're going to see is on the left, the increase in murders last year, which that's a pretty big increase, wouldn't you say? Atlanta.
Oh, yeah. Well, I'll just read some of them out. Atlanta, 58, Chicago, 56, Dallas, 24, LA, 31, New York City, 39, Minneapolis, 74%.
Yeah. So this is really awful, but so for the person who's dead, that's going to change their behavior. And for the person that killed them, that's going to change their behavior. So, I mean, maybe Lena wants to edit that out.
No, we don't want to give any extra work to Lena, so we'll leave it in.
So you're already seeing a change in behavior. And
Right.
And now the next thing I like is this is awesome. Everyone's going about how much more productive they are working from home, right?
Yeah.
So I've clipped this thing. It says 9 in 10 people have admitted to drinking alcohol while working from home.
Well, at least we were upfront with it right from the start. We never pretended any other differently. But that is hugely different than at work, right? Like, let's face it, most of us don't drink while we're working.
Okay, so as I continue down this path to Armageddon, I would say virtually everybody I know has gained weight in the last 9 months. Okay, so people are drinking more, they're eating more. I didn't bring the slide, but the number of increased prescriptions for psychiatric drugs has exploded.
Yeah.
Okay. Now, what we know is it's easy to put on weight. It's easy to start drinking more. Yeah. It's easy to take medication that makes you feel better. And it's fucking brutal to get off of them.
Right.
So, I'm not going to say that in 2 years it's going to be back like when my grandmother, when I was little, took me to the diner and she'd steal the sugar packets because she was from the Depression. But this notion that we're going to go back to some sort of, hey, that's how it was, I'm not excited about that.
So are you arguing or kind of putting out there the idea that this is so traumatic, this is going to be a wound on the investor's psyche for years and decades to come?
Well, I was going to say it this way, which is I think it will be a wound on consumers' psyche. And since consumer spending is 2/3 of the economy, right? Yeah. That is going to bleed through to how companies do.
So you're a seller of the idea that come the point when we're all vaccinated, that there's this huge built up, pent up demand that is going to be unleashed and set about the roaring 20s of this century.
I think that you have, I don't like to make predictions, especially about the future.
Yeah.
But
You stole that from Yogi. You stole that from Yogi.
I just like to throw it into the mix because, when you have the stock market at all-time highs and you have interest rates at, for sake of argument, at all-time lows,
Yeah.
right? And you have credit spreads at the tights and those
Yeah.
sorts of things. These are times I think it's worth taking a step back and kind of taking a view from 10,000 feet. And the second element of this, it's a little bit more not economic, but a little bit more about the math. So we all focus on these statistics that get released, right? Whether
Yeah.
it's our earnings, non-farm payroll, producer prices, blah, 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 blah. Okay. The other thing is there's a huge amount of seasonal adjustments in these numbers.
Okay. Yeah.
And so now as we get numbers going forward, March, April, May, they're going to look fucking awesome.
Oh, because March, April, May of 2020 was so bad.
Yeah.
And therefore they will have been adjusted downward to take into account them. It's almost like they should take the last year, not include them in the seasonal adjustments, which of course they won't do.
No, why would they?
Yeah.
So once again, I don't have a dog in this hunt, right?
Right.
Like I'm not suggesting you get long, you get short. But what I'm finding is that there's things here that make me a little bit concerned. And so one of the very few benefits of getting older is you get a chance to read a little bit more and you get to accumulate some knowledge. So if we go to this next slide, I'm reading a really good book about World War II. Okay. And in here, you see them talking about 1931, where prices of goods are going up, cost of living is going up, jealousy of other people's profits, feelings that are not problems are not fairly shared. We may run into strikes. A lot of the things we could see happening in our time. And that thing about those who learn history are doomed to see other people repeat it.
I know. Is that a great line?
I'm just trying to be a little bit cautious about how we move forward with this stuff.
So Morris, I have a question for you. So I was thinking about what you were saying in terms of the psyche of everybody, gaining weight and doing and the consumer behavior changing. But I think that when people are depressed, shopping and spending money is the way they try to buy their way back into happiness, maybe falsely. But I feel that when everyone has been cooped up, even though everything you're saying is true, what if it's the opposite, where people are trying to get out of that rut by spending beyond their means to try to relive what they feel they lost in the last couple of years
That's a great question. And I have a little bit of sense of what you're talking about, because in the last year, I bought a sports car and I bought a second home. So I'm trying to heal thyself.
So, Morris, is this your first? Like you've done this before with the sports car, right? Don't tell me you've waited all this time to get yourself the toy.
No, I'm so far past this.
You've gone back and done it again, is what you're saying. You thought you had outlived all your sports car days. You went through that stage. You thought you were above that, and you found out that no, you're not above it.
Every time I get out, they pull me back in.
Well, listen, this quote made me kind of shiver a little bit, though. I see it's Chamberlain fretted to his sister. Yeah. Chamberlain, the famous appeaser.
I don't know how much you've read about World War II. It's a thing I kind of like. My father had been a big fan of the history. It's funny because there's this saying how history is a bunch of opinions supported by some loose facts.
Okay.
And I was blown away with how much I misunderstood about Chamberlain, and even things like, if I said to you that in France, the Maginot Line,
Yeah.
right?
I know what it is. Yeah.
Okay. And everybody thought, like, how stupid is that thing, right?
Yeah. Because they just went around it or whatever.
Well, I just read like 20 pages on how they went through that thing, and I'm like, the thing was fucking awesome. It was just.
But I thought they didn't go through it. I thought they went around it.
They did.
Yeah.
But like every German general was saying to Hitler, you don't want to do this.
Yeah.
This is
right.
a mistake.
Yeah.
And it was just, he was so fucking crazy that he did something no one was going to do.
I can't imagine him, like people being crazy in this current environment. There's nobody like that out there today.
No.
Listen, the next slide here, before I get myself into trouble and say who I'm thinking about, why don't we talk about U.S. dollar swaps? What is this?
So this is actually consistent with what we're talking about. Oddly enough, I managed to tie together two cohesive thoughts.
Okay.
So if riddle me this, Batman, if the economy down the road, and Patrick, to answer your question, if everyone's going to go run out with this huge euphoric blast of spending money, why are interest rates going to be in the ones for the rest of our life?
Oh, because they're not convinced that we can make inflation. Market's wrong. That's what's that.
Well, so basically you've got the stock market and the bond market. Okay.
Yeah.
My experience is the stock market tends to be substantially more volatile because you have this price earnings ratio and then you have earnings forecasts, right? So there's a lot of story in there. When you come to the bond market, this is real people doing real trades because they have to do them. And so when you look at the 30-year yield, so let's go all the way to the left side of the screen, and down in the second column, the 30-year, it's a 1.58. Okay,
right.
You with me? So this is the LIBOR curve, and I like it because it's a smooth curve and all that. But you can see as you read across the bottom to the right, they're saying the 30-year rate 10 years from now is going to be 1 3/4. That's not materially different than where it is today. So where's the growth? Where's this?
So I'll push back on this one.
Okay.
1981. We probably didn't have a very good dollar swap market curve back then, but my suspicion is that if you had gone and looked at it then, it was wrong. That it was too high, and wasn't taking into account what was going to be the next 40 years of a bond bull market.
So don't bring a knife to a gunfight, my friend.
Yeah. Why was there a swap curve back then? Was there a swap curve back then?
No, but I'm guessing. Okay.
Yeah.
What you had is a severely inverted yield curve.
Okay. Yes, but you still had 30 years at 15, 16, 17%, right?
No. And I just got off the phone. I just had this debate with Jim Grant last week. You might have had a 30-year rate, let's say, call it between somewhere between 12 and 14%. Okay.
Okay.
And you had the short rate at 21%.
Right.
So the curve's inverted, right?
Yeah.
So
so Bloomberg showing the 30-year as hitting 15, 20, and then at the time, you want to use fives or twos?
I'd use twos.
Okay, so let's look at twos, and then the twos at the same time were, let me just get rid of this, were 16, almost 17. So it was inverted, but it wasn't like,
okay. All right.
Yeah.
Okay. All right.
And the bond market didn't understand the dramatic shift that was about to occur with.
That's fair. Okay.
Yeah.
Okay.
And so that's my pushback. And listen, I might be wrong. I've been wrong for the past 10 years, thinking the bonds were a disaster waiting to happen.
Just 10. Just 10.
Yeah.
No, it's probably 25. But anyways, but
let me ask you this then, just to like push back against your pushback. If the rates are wrong, if these interest rates are wrong, what's that going to do to stocks?
So that is, I think, a terrific question. And I don't have the answer to you because although I think that the long end is wrong, I'm not so sure that the short end is wrong.
Okay.
I do think we're going to have financial repression and they are going to be very, very slow to raise rates. And in doing so, we are going to have an extremely steep curve.
Yes.
And then the question is, does the stock market get excited about the fact that credit is being created because of the steep curve? Right. Or does it start to get competed for with the longer real rates going higher? And I don't have an answer.
I agree with that. And I'm actually, I'd like to get your guys' view on this because, the big question with the long end is going to be inflation, right?
Right.
And so I'm really confused on this because on one hand, I buy into the Lacey Hunt notion that they're not printing dollars, they're changing the duration of the debt, right? They're swapping Federal Reserve notes, which are short-term, for bonds. So there's no, right? So they're changing.
Okay, that's QE, and I agree with that. I wouldn't call it Lacey Hunt. I think that even MMTers would agree with that.
Okay.
Yeah.
But the Lacey Hunt part is the issuance of the bonds is basically bringing future growth forward. So the more bonds they issue, the slower growth is going to be.
That is correct.
Okay.
Yeah, you're absolutely right.
So I agree with that.
So he sees very little difference between a currency issuer and a currency user.
Yes. So what I'm conflicted with is if you look, and GaveCal had a great piece on this today, there's something like $3 trillion sitting in people's demand accounts. If you look, I might not have that exactly right, but I certainly know if you look at M1 and M2, the nation's money supply, basic money supply, the growth rate is extraordinary, right?
Right.
And so the only reason we haven't seen huge inflation is that the velocity of money has collapsed, right? Because it's at MV equals PQ.
Yeah. Okay. Yeah.
So to Patrick's point, if people start buying stuff, okay, is that going to just temporarily change the velocity of money? Are they going to go out and go on a 90-day binge, or is it going to be, is it going to carry on and people are going to start worrying about the prices and buying and holding because they think the prices will be higher down the road? I'm conflicted between those two things. So,
well, I would say that what's even more important is, we're focusing on this side of it, on the private credit creation, and we're thinking that that's the only way the economy can grow. But as we've seen over the last year, that the government can fix a lot of holes fiscally. So the real question to me is, does the government get scared about the debt they're piling on and try to go back to balancing the budget? Do we get a return of the deficit hawks? And if we do, then I think that what you're going to find is Lacey Hunt ends up being spot on correct. If you believe that the government is like any other household and is bound by those rules, then it's inevitable that we will get lower and lower growth.
So I know you guys are up in Canada. Maybe you heard the other day a bunch of people went into the Capitol and expressed their discontent with it.
Yeah, we might have heard that there was something that happened in Washington. Yeah.
Yeah. So you tell me, you think people are going to stand by and listen to, you got to tighten your belt and
Yeah, I don't think so. And that's ultimately why I believe we're going to have inflation.
yeah.
But that's, but so, though the real question to me, though, is going back to, let's bring this back to your first point of the problems in our society dealing with this virus. We are still not out of the woods. Even though the market is looking through and trying to price everything based upon everyone getting vaccinated and saying by September or whatever the date is, everything's going to be hunky-dory. The reality is we still have a tough, 3 to 6 months ahead of us. Here in Canada, we're already worried about, under current projections, that we're going to have to turn away people at the hospitals. I saw in LA, they're not picking some people up. If you're in LA and you ask for the ambulance, and if they think you don't have a good chance of making it, they don't take you. They don't waste the oxygen on you. It's scary. And what I worry about is that we are going to have even more stress that you talked about, and this winter is going to be a really, really difficult point. And does the stock market, does the financial markets eventually, do they stop saying, you know what, forget about September or next year, it's bad right now, and does that eventually bleed into the financial markets? And I think that's the question. So what do you think about that, Morris?
Yeah, well, it's funny. Patrick jumped a little bit ahead with this next slide. I'll come to it in a minute, but when you look at big moments in history, okay,
yeah,
a lot of shit happens at the same time. So you've got SPACs, you've got Bitcoin, you have the Robin Hood thing, right? And when you look at all these things, I would say to you that they are kind of a symptom of part of all this stuff that we're talking about.
Okay.
That people are, a lot of people are sitting at home with nothing to do or little to do. You are in a bull market. Other than 2 weeks, was it last March? We've had a bull market for the last several years. It was the shortest bear market I believe
ever
in history.
Yeah, for sure.
Just fucking, they couldn't give me one more week. I was there.
It was a little longer than 2 weeks, but yeah, it was a month of real pain.
Yeah.
Yeah.
I think there's a speculative fervor in the air, and I think that we run the risk that there's I hate this term, but black swan event. But maybe it's the health stuff. Maybe it's just it's that Satan's bushel. Maybe the last guy.
What's that? Wait, I don't know Satan's bushel. What's that?
There's a book written, not 1688. It's a little newer than that, but I want to say a book in the 1920s written by, I think the guy's name was Garrett. And Satan's bushel talks about a commodity trader, and Satan's bushel is that last bushel of grain that trades at the high. Like that very last bushel.
That's awesome. I never heard that before.
And to your point, I was to this point. So I've heard you and Patrick go on and on about guys in Canada touting the penny stocks and how. Okay, so this friend of mine tells me about this penny stock in Canada, and it's a mining company, and I find myself picking up the phone to buy the fucking thing, and I go, wait a minute, you're 0 for 8 in Canada, and so I don't know.
Cuppy says that there should be some infrastructure up here in Canada named after him because he's contributed so much to the Canadian economy with his speculation in Canadian penny stocks. I just found it. It's 1924.
Yeah.
And it's written by Garrett. It's such a good name that his parents named it him twice. Yeah. So there you go. And I'm going to put it on my list of things to read. So we learn something each time from Morris.
Hey, can we talk about gold and Bitcoin for a little bit?
Sure. Yeah, let's do it.
Yeah. So first thing I want to say is gold. Okay.
Yep.
This thing trades like 8 pounds of shit in a 4-pound bag.
Yeah. All I can tell you, Morris, is that I can't tell you how many people are telling me that. All the gold bulls, they got to be like it's got to be getting like cleaned out, because I don't know who's left. Everyone hates it now. I very few people like it anymore.
I hope you're right. You know, there was this one economist, a Canadian economist, and he quotes this fellow Bob Farrell all the time. Okay,
so I don't know who you're talking about. No idea.
Bob Farrell has 10 rules, and like rule number 6, whatever, is like when all the experts agree, it's going to be wrong, right?
Yeah.
So I send this guy an email, and I list 10 people who are household names in the world of finance, and they all like gold. And I send him this note, and I go, "Hey, riddle me this. Tell me this. If these 10 experts like it, how's it going to go up?" And I get this bebop boop answer like, "Well, you know, the open interest." And I mean, it's done nothing but go straight fucking down from there.
When was that you said that?
I'd like to say August 6th, but and the only reason I know that's the date is because I turned 60 on the 6th.
Oh my God! Right on the day.
Right on.
It topped on that day.
High.
It's your fault, Morris. It's your fault.
You did.
Yeah.
Okay, so gold. I think that gold is suffering from the Bitcoin. I just look at the people that are, Raul. God bless his heart, and not only that, he's nailed the trade. He's been, as he calls it, irresponsibly long. He made a big show of it, selling all my gold to buy Bitcoin. And I got to think that there's a lot of people in the same boat. I think at the margin, all that money that, is worried about potential debasement, worries about inflation, it's going into Bitcoin.
I hope you're right.
So I think the question is, do you think it cracks? And I know you have kind of almost moral issues with it. I have kind of philosophical issues with it, because I think it's a dumb technology when you look at the other technologies out there. I don't understand why anyone owns Bitcoin over BSV, but I get told all the time I don't understand, because I actually expect it to have a value. I literally get told that. I'm like, you don't understand Bitcoin because you expect it to have a value or a purpose. It has no value or purpose. It is all about the network effect.
So one of our earlier podcasts, I'm vain enough to go back through the comments and see what people say. Most
vain or proud? Or brave, because I can't do it.
We talked about cryptocurrencies, and a couple of guys slammed us for being dopes.
Yeah.
And what's funny is what you and I kind of laughed about, if I recall, is what do you do if you lose your fucking password or something?
Yeah.
And there was a story, and I don't know if it's true, but it was in the New York Times. Some guy claims to have $200 million worth of Bitcoin.
Yep.
And he's used 8 out of his 10 guesses on the password.
Yeah, he's used it as some sort of storage locker, some sort of technology.
Yeah.
And he's got 10 guesses, and he's done 8, and now he's stuck, and he doesn't want to guess the last 2. He's really thinking about it carefully, because, it's gone.
So the thing about the Bitcoin is I don't know where the price is going. Okay. I would say all things held constant, it should trend higher over time, because people are going to lose it. So there's going to be less of them. So that's the supply side.
Yeah, but there has to be more demand.
Yeah, the demand may change. Now, what I have with the Bitcoin that are kind of philosophical problems are, there's no regulatory agency that makes sure that the people you're dealing with aren't fraudulent, number one. Number two, there's no way for anybody to guarantee the security of your Bitcoin. For example, if you have $1 million and you buy a United States Treasury bill and you walk it over to the United States Trust Company and you put it in a custody account, okay?
Yeah.
That is backed by the capital of the United States Trust Company, which is owned by the Bank of America, which is regulated by the Fed and the SEC,
Right.
and it's insured.
Yeah.
Okay. So if you wake up one day and that money's gone, you're getting that money back.
Yeah.
Okay. The Bitcoin thing, there's a whole host of ways something could go off the radar. Like you forget your password, or you put it on a chip and it falls out of your pocket into the toilet.
Yeah.
And then if we could go back to that slide, like the Warren Buffett thing, which I would like to point out. So he's talking about cigarettes, right?
Yeah.
And he says, I'm wealthy enough where I don't need to own a tobacco company to deal with the consequences of public ownership. Okay, so let's go back to Bitcoin for a minute. So the internet, and I sent you that paper offline the other day about distributed communication systems.
Right.
Okay, so that paper, written like in 1963 by the Rand Corporation, outlined the beginning of the internet.
Okay.
Now, the internet was created to provide a command and control structure for the U.S. military in the event of a nuclear attack.
Right.
It's a distributed information system. So if the home office gets blown up, there's ways to communicate with your comrades. Okay. So as the internet developed, they decided to use it for sort of like espionage things. And what they then discovered was if you had a spy or something in a foreign country and they were trying to send messages on the internet, the foreign country could see there's internet traffic and
Right.
they could, okay. So the Naval Signal Corps developed the dark net, or what's called the Tor net, the
I
onion
didn't know
router
that.
net. Okay, yeah.
Okay.
So, but once again, unless there's traffic on it, the foreign countries can tell that it's espionage related stuff. So the United States government went out and hired, bad guys to traffic on the Tor net to create a lot of activity.
Come on, really?
There's a book called Surveillance Valley,
Yeah.
and the kid maps the whole thing out. I'm dumb, but I'm not stupid. I couldn't make this stuff up, right? Okay. So now, so now you have the United States government creating an infrastructure for bad guys to move around. But there's a purpose to it, which is to provide cover for domestic espionage and information
Okay.
transfers. Okay. Now we have the Bitcoin. The Bitcoin is used by bad guys. It's used by guys selling drugs. It's used by bad guys hacking people's computers and ransoming them. I'm sure, I won't even say the kind.
Yeah, there's lots of other bad guys that use it, right? Okay, yeah. Right, yeah.
Okay. And most importantly, it's a way to evade, not avoid, but evade taxes.
Okay.
So why in the world would a government allow this to take place?
So why are they?
Beats the shit out of me.
So are you worried? Okay, so wait, let's just make your first point, which is basically you made the same decision that Warren Buffett did, which was this isn't really a good thing to promote. Therefore, I might be able to make some money, but is it really worth it? I can go make some money somewhere else. Is that correct?
100%.
Okay. Now let's talk about why the government has allowed it and whether that you view as a real risk going forward.
Oh, fuck. It's a great risk. I mean, can you imagine I call up, I'll try and be professional. I won't use her nickname. Let's say I call up Elizabeth Warren
Yeah.
And I say, okay, Liz, it's Morris from the Market Huddle, and I got a great idea to raise revenue. And she says, Morris, what's that? I said, transaction tax on Bitcoin.
Yeah.
Or Elizabeth, you've got people avoiding paying income taxes, and it's the rich, it's the 1%.
Yeah.
Right. I mean, the guy who's flipping burgers, ain't making a ton of dough off the Bitcoin. It's a regressive kind of situation. You got a bunch of rich people doing it.
Yeah.
And so why in the world wouldn't she like to get rid of something like that? And the point about the long-winded thing about talking about that DARPA paper or the RAND paper about how the internet was created and then the Navy Signal Corps is, don't kid yourself. If the government wants to stop the Bitcoin, okay, they can stop the Bitcoin.
Yeah. No, I 100% agree.
That tough.
Yeah.
So,
and
all of it goes through routers that are actually owned by the government or administered by the government. You can't, and not only that, the other one that really I wonder about is, let's say we go to war with China, like not even war. We just go into let's say
financial war.
Financial war. Yeah. You know what happens all of a sudden when you cut the fiber optic line between U.S. and China? The whole Bitcoin thing's going to fork. It's going to be a disaster. These people assume that everything's going to continue working so neatly and that this is a true store of value. Maybe they're right. Listen, I've been made a fool of. It just keeps going higher and higher. But I certainly feel a lot better owning my shiny metal than I do than the bits in the sky. And call me old, called me don't really understand the technology, but that's where I stand on it. I think that you're 100% right.
So
what I was just going to say though, like Christine Lagarde just came out a couple of days ago calling for regulation of Bitcoin's funny business. Yeah. I mean, you're already seeing the biggest curse for Bitcoin is actually becoming big enough that actually governments start to care.
That's right.
So the higher it goes and the bigger it becomes, the more the governments are pushed into having to deal with it.
Can I say one thing here, actually, though, Patrick? The Lagarde comment struck me as terribly ironic, because the whole reason, if you think about Bitcoin from a European perspective, they're trying to get away from the negative interest rates. So instead of going and realizing that their policies are just batshit crazy stupid, having negative rates, they're trying to go and they're trying to outlaw the things that people are going to try to get around these negative rates. It reminds me of that Carmen Reinhardt, and he basically wants to get rid of cash so that he can put rates at minus 500 basis points. It's the stupidest thing in the world. The governments are taking the wrong message from it. So ironically, I actually think that if I was a European, I might actually even buy Bitcoin, because it means that they're not very serious about changing their policies and getting rid of these awful negative rates. But anyways, that's another story.
What's wrong with getting rid of cash and having minus 500 basis point? I think can
Really?
I vote for that?
Honestly, you think?
How about for 60 days?
I think it's a terrible policy, and I think it's Europe is just asleep at the wheel, and the negative rates will go down as the greatest central bank blunder ever. It really could be ever. It's that bad.
Yeah.
Well,
I don't know. That's my opinion. That's what makes a market. What's your next slide here? What do you got? What else you got for us, Morris?
So basically, we might as well use these slides since I brought them.
No. Let's talk about it.
So basically, kind of going back to what we talked about earlier with, the Wall Street guys kind of putting positive spin on the economy and growth. I wanted to show a couple of examples. It's sort of a modern day, where are the customers' yachts?
Right.
And so, the greatest trader, the GOAT, the greatest of all time, Renaissance Capital. If you see here, they talk about how the fund that the employees' money in had incredible returns, right? And then the money that schmoes like you and I give them, well, I don't give people money, but you know what I'm saying.
Yeah.
They're are relatively mundane. So James Simon's got $24 billion and you got your 6% compounded rate of return. Awesome.
Right.
And then
they're not sharing that the 100% annualized return with anyone.
No. And here's the best one. If you click to the next slide, I don't know if you'll be able to read it, but it talks about Michael Platt was joking in the back of a cab how he was making all that money, yet you can see the headline that the clients got the B team traders and the Blue Crest managers kept the best stuff for themselves.
Yeah, no, it's definitely there's a lot of duplicity with some of these fellows in terms of running their funds. But do you think it's getting worse?
Dude, I don't know. I've been out of the business since 2013, and I'm getting a little older, which I find makes people a little crankier. In fact, the man who introduced me to your blog, who is preferred I don't mention his name, we have a little club. We call it the Old Men Shouting, "Keep off the grass."
At least it's not yelling at clouds. That's when you get a little more senile. You're yelling at clouds. That's what happens when you hit 80.
That's next. I helped my son-in-law with something, and he said, "You're the man, MB." And I said, just pick out a nice nursing home for me, will you?
That's right. Oh, that's funny. That's funny. Actually, I'm looking at your picture here, and I don't think we've ever talked about it. I see that you're reading a book, Option Selling, and who wrote it?
So there's this fellow. God is going to smite me for this. You know that, right? So I don't have a lot of pictures of myself, and Lena said, "You got to send us a picture so we can put it up." And I'm like, we've spoken many, many times, right?
Yeah.
And you know that for better or worse, I don't take things too seriously.
Yeah.
And so this fellow, James Cordier, was a fund manager who made money shorting options.
Right.
And you know how I feel about shorting options, right? And so when he went broke and put up that YouTube video crying, wearing a $25,000 gold Rolex.
I know.
That's optionsellers.com or whatever, right?
Yeah. So I went out and I bought a first edition of that book. Because I think but I thought, and this is what I was kind of doing. I was hoping, there's those things called Easter eggs where you hide these little things.
Yeah.
I was hoping someone was going to notice that. So unfortunately, I got to give your listeners an F on that. I mean, come on.
That's hilarious.
He
was. And by the way, you know what? Excuse me for
no problem.
You know what? He shorted options on nat gas.
I know.
Call options.
Yeah.
Call options specifically. But you know what? He must have been at least 3-4 times leveraged on top of that. Like concentrated, leveraged, all in one commodity. Like the nat gas has got the Widowmaker.
Patrick and I went through the math, and he had a chance to get out because I remember it gapped higher. Remember, Pat? We went through it and we figured out that, and we kind of decided how big he would be and then what it was going to be like. And I think he had basically a chance for him to get out at down 20% or 25% when it opened higher. And I think he then proceeded to let it go, and it just kept
double
climbing
down.
there. Yeah.
What if he?
Nobody moves when something moves like that, and that's one of my huge criticisms of option pricing models. When you get a jump like that, you're paralyzed. You're 100% paralyzed. And so this notion that you can rehedge and this and that, I mean,
there was that famous fellow in the Market Wizards, I think it was Monroe Trout, and he had a stop loss on his portfolio. And I can't remember, I think it might have been 10%, or 5 or 10%. And when it hit, he had instructions with his traders, and he would actually leave the room
Yeah.
because he just knew he wouldn't be able to do it.
Oh, yeah.
Yeah.
We had guys, I worked on the floor of the Board of Trade as a summer intern a couple times.
Yeah.
And that was one of the things in our group. There were brokers and traders. And when a trader kind of hit his stop loss, he handed his deck to one of the other guys in the group and they made him leave the pit.
Oh, really?
Yeah.
Now, was that just a daily stop loss? Like they would have like a limit on the day?
I don't remember.
It is hard though because you're not thinking straight anymore, right? That's people don't understand. Till you're there, you just don't understand it.
That's why when I started telling you about this metal trade that I've been doing,
Yeah.
I picked an amount of money and I said, this is it. And if I lose it, it's going to be a bunch. But I can't start telling myself stories, and right. I mean,
Right.
because I know I'm human too, and I fuck stuff up all the time. But I like to be in situations where there's no debate about how much I can lose because people are human.
Yeah. So did you see that you were on a prop desk at a bank, and like, did you see times that you must have had people under you that you had to take positions away from them and send them home?
Oh yeah.
Yeah.
I mean, it's funny because, typical Wall Street, I ended up managing people at a pretty young age because I made a bunch of money trading. So
Right.
Wall Street, good trader, he must be a good man. Okay. And what I found is traders, when they're losing money, exhibit the exact same behavior as the Elizabeth Kubler-Ross 5 stages of death.
Okay, give us the 5 stages. I don't know it. Like, go walk us through it. No, I don't know them.
So it's like they get angry,
Yeah.
they're in denial, they negotiate. I mean, you can look it up.
I should go get them while you're.
And so basically, it took a couple of years for me to kind of get accustomed to, being 27 and telling a 40-year-old you're out.
Oh God,
right?
you were young when they did
it.
Yeah.
Yeah. That's why I'm gray and I got no hair left.
And how did they take that? Some 27-year-old telling them to take their position off.
Well, initially, this is where I learned the 5 stages of death, right?
Denial, anger, bargaining, depression, acceptance.
Boom. Right.
Okay.
So initially, I went through those 5 stages of death with them, and it always resulted in them losing more money before I took them out.
Okay.
So this is what I ended up doing was when they got to their stop, I went in the room and I said, "You've hit your stop.
Yeah.
I'll let you take the trade off if you like, and if you won't, I'll take it off for you. Which
Right.
would you prefer?"
Yeah.
And that was how I did it.
That's
Because
good.
there's just no, because it's the same thing.
Yeah.
Like if you don't honor the stop, you're not. I mean, it's a business. This is not
listen.
a popularity
Honoring the
contest.
stop has got to be. If you were to take, put trading into one kind of little tidbit, that's probably the most important one. Honoring the stop.
Yeah.
I have a question for you, though. You mentioned that you were a manager at a young age. I kind of have thought about this, and I've realized that they go and they take the best traders, and they then make them managers. And often, what makes you a good trader does not make you a good manager.
Yes.
And I've always kind of laughed and said, really, they should not be putting any good trader in charge of managing people. They should be getting people that actually enjoy and wanting to bring out the best in people and actually care about them. Like how many trading managers they treat you like a trade, and that's in there's no real surprise to that because that's how they're built.
Okay, so I'd like to address this because I think this is a pretty interesting question. The thing is, there's 2 kinds of businesses in my mind. There's the hedge fund business, and then there's the old school Wall Street prop desk. Okay?
Right.
The hedge fund business is just run them through the mill, see who sticks, and if it works, great. If not, get rid of them. It's just there's absolutely no cohesiveness to the way the business is. You know, you're subject to your daily mark, your weekly mark, your monthly mark, and that's one of the reasons why I'm not a big fan of it. Back when there were legitimate prop desks, and the one I was at for 16 years, Greenwich Capital, it was a quasi partnership in that we would go to a risk meeting. And so if I was the head of prop trading, I would be in there, the head of the government desk would be there, the mortgage guy would be there, and we would talk about our big trades and big risks on a weekly basis.
Right.
So if something went wrong in one of my trades, it wasn't the first that these guys heard about it.
Right. They knew about it.
They knew about it.
Right.
And then secondly, they knew me. Right. It wasn't just they read a resume and they got to hire 30 new traders. You know, after a couple of years of being around, they realized that when I told them XYZ, it was going to be XYZ, right?
Yeah.
And we would take ownership in everybody's risk, meaning ultimately it was economic ownership because we got treated like a partnership. So if mortgages lost a fortune, then it was going to affect my P&L, and if I lost a fortune, but for the most part, we were standalone entities. But it was a partnership in terms of it was moral support, it was asking intelligent questions, and if the questions weren't intelligent, at least they were politely asked. So you didn't have an adversarial situation. I worked for a hedge fund, and I won't say the name, but the risk manager had a PhD in electrical engineering. Okay. And so we went in there and we saw a bunch of their systems were wrong. Okay.
Really?
Just fucking wrong. And so we did a trade, and it was a futures trade.
Yeah.
So let's say it's March and the trade settles in June.
Okay.
So there's 3 months between today and when the trade ends. So you've got 90 days of interest rate exposure.
Okay.
You with me so far?
Yeah, for sure.
Okay. So in those 90 days, if the short rate moves up or down.
Yeah. You had funding risk on the
funding risk. Okay.
Okay.
So we had a big trade on. So I don't know what the number was, but let's say hypothetically, I had 22,000 April Fed funds contracts to hedge. Okay.
Right.
So the guy is like, what do you need those for? Why are you speccing those things? And I'm like, it's not a spec. It's and we went round and round for 2 weeks until the fucking light bulb went off. And
that's actually shocking. Even I get that
because they had a large number of
trillions probably of funding that they were.
I don't want to say the number because
but it was big.
It'll give it away, but it was enough that like, are you fucking kidding me?
Yeah, that you don't understand that you have overnight risk on this.
Yeah.
So, I can't remember which of the market wizards was that. It was a currency trader, and I remember him talking about something happened overnight, and there was a gap on his positions. And he went to, I think it was Goldman Sachs, but it was very much a similar story. He went to explain to his boss, and he said the thing that struck me the most is he said something to the effect of, they said, "What are we going to do about it?" It was no it was no like you screwed up, like trying to do it. It's like, okay, we got a problem. What are we going to do about it? Let's fix it. Yeah. And I sympathize, and I think that's a great attitude. Do you think that exists anywhere?
I don't know how it can.
Really?
I suppose it might. Once again, I can't give you an answer with any honesty.
Yeah,
I can guess, but I'm just, like I said, I'm removed from it long enough that I don't know, but I don't really see how it could.
Maybe could be in stuff like HFT, like those. They might be viewing it like there's partnerships in there, and that there's some inner workings going on there. Because let's face it, back then, nobody would have known that's how you were operating at Greenwich. It's only now in hindsight that it becomes obvious that this is the way you were going. So, there's probably is something going that way.
Yeah.
So, okay, we're coming to the end here. What do you think? You got to give us some predictions or some thoughts or some ideas. What is the next, we're not probably going to talk to you for a month or two. What are you worried about over the next couple months? What are you looking at? What are your ideas? Anything? I'm putting you on the spot.
No, it's fine. In fact, one of the most fun things I had with you guys was doing that bet.
Oh, the bet. Well, I should have let you pick up Patrick's bet this next week. Well, I'll tell you what, the next time you come on, you can do the bet. We'll let you do the bet. But in the meantime, I'm putting you on the spot. So what is the market missing or what are the potential things that, might be an opportunity for investors that the market might be missing?
Well, I don't give investment advice.
No, of course.
Okay. But what I'm focused on is this, that back in the day, they would tell us that it took 12 to 18 months for monetary policy to work its way into the financial system.
Okay.
So, for instance, if the Fed started easing, it didn't work right away, right?
Yep.
So, I don't know whether I think or whether I hope. I certainly know that I hope.
Yeah.
That if you look at the jump in the money supply numbers, which was March, April of last year.
Yeah.
So I think March, April, May of this year, you might start seeing the stuff go in the commodities, like the rate of increase.
Okay.
Because at some point, people are going to stop putting money into the equities. The numbers are going to be ridiculous, and they're going to find their way into real hard assets.
Okay.
So real estate, not levered, not like investment, but like, houses should do well. The metals should do well. I've seen the grains have done very well. I don't know about energy per se, but in terms of the level of the market, stock market, stuff like that, I don't know. But I would expect the dollar to be lower against especially the Asian currencies.
Oh, okay. Tell us about that. Why do you feel that way?
Well, just the ECB's fucked. They don't know what they're doing.
Yeah.
And we're printing dollars, with all due respect to Lacey Hunt, it's just an easy phrase to say we're printing a lot of dollars.
Yeah.
And the stuff in Asia doesn't seem to be quite as damaged as it is between here and Europe. So it's the
would you extend that to actually buying like Japanese equities or any other like Asian equities?
I don't have I'm not that.
You're not an equity guy. So you're just looking at the currencies and saying maybe that's the exposure that I'm looking for. And then the main thing though is real assets. So we can expect more lumbers. We can expect more, corn, soybeans, all these things that have exploded higher. We're going to see this expand to other commodities.
Just not to drone on too long, but if you go and you look at the things that the wealthy people like, those prices are fucking ripping.
Yeah.
Like if you look at the high end.
I hear that the Greenwich wine has gone up.
and the sports car market.
That's right. Greenwich wine sports car market is second
It's so
homes.
hard. Do you know what I had to pay
And
for
second homes.
1995 DRC the other day? My God. And they didn't take the fucking food stamps. You guys are great.
Well, it was great having you, Morris. You know what? You're still not on Twitter. You don't do all that stuff, so we don't have anywhere to point anyone, right?
Well.
Okay.
Well, I have a young friend
who
has got me to agree to. We're going to try and do a podcast.
That's awesome. That's terrific.
And I'm not going to talk about it, the name or anything yet, but it's going to be. Talk about investing for younger people or unsophisticated investors.
Right. For those who want to know, well, I shouldn't say too much, but Morris's definition of a young friend is a lot different than most people's. It's let's say Yeah, you've changed generations, but barely. Okay, so, or have you changed generations? Might not. Anyways, doesn't matter. So listen, when you get that going, you got to come back on the show and tell everyone where they can find it, and hopefully it won't preclude you from joining us on a regular basis. Still,
No, I look forward to hanging out with you guys. It's a blast. It's a lot of fun.
Well, thanks for being on today, Morris.
Thanks a lot, Morris.
Okay.
All right, cheers.
You guys. Take care.
Patrick, time for talking charts. What do you have in store?
Well, let's first go and re-review what we had as our top 3 last week, and so we were talking Bitcoin. We asked whether the New Year's money runs out this week, and we were talking about that 10-year yield, and really, well, I mean,
they were all duds.
Well, no, I mean, Bitcoin did have a lot of volatility in the last week.
Yeah, but
right?
It's a day ending in Y. It's nothing new for Bitcoin.
Yeah, no, it's true.
Yeah.
But like, you know what? I mean, we're going to talk about our bet in a little bit.
Yeah, we better not talk too much about Bitcoin. But about the stock market, in terms of the rolling over, no signs at all. Or I don't know, maybe not no signs. What do you think, Patrick?
Well, let's talk about that in a moment. The one thing, though, I do want to say is that we goochered the 10-year yield because literally the moment we talked about it, it makes it onto the show, and the moment it does, it stops. So we goochered the trade. All right, so let's talk about the top 3 things this week, and we had to go back. We can't not talk about this because it's Tesla and Bitcoin, and whether or not we saw just them taking a break and pausing before they resume higher, or whether or not some more intermediate, if not ultimate top to this entire advance is shaped up. And the reason this is important to me, Kev, is because I honestly continue to believe that it's when Tesla peaks out. Now, not that we know it has, but when it does, I think that's when the stock market will start to have a sentiment shift that could cause that correction and mean reversion. And so answering this question as to whether these reversals that we saw, let me pull up the chart on Tesla. But one of the things that I always look for is when we have a reversal day like we had earlier at the start of the week. I always say one day never makes a new trend. It's all about the way it trades after that sell-off. And in my mind, if Tesla turned around and later this week ripped through 900 or earlier, like a few days ago, ripped through 900 and brushed off that sell day, then that would have just been noise. But really, it has not found any new buying ever since that reversal on Monday. And it kind of puts a red flag. We have to pay attention. I'm not predicting that it is. I'm just saying this is sometimes how these things turn. And we have the first crack in the armor. Let's see if it actually can wound the stock.
So is Tesla the canary that you're watching?
Oh, absolutely. For the stock market, yes. Well, you disagree?
No, not at all. I just don't want to gooch and talk too much about Tesla.
Well,
Bitcoin. Let's talk about Bitcoin. I do not. Well, that's not true. I was going to say I do not have any Bitcoin positions, but I foolishly do.
What with your
Mr. TR or whatever it is?
Yeah,
MSTR.
MicroStrategy.
I'm learning the hard way about the Bitcoin mania.
Yeah,
that's crazy. I'm getting run over, but so be it.
But this is the same pattern I just talked about in Tesla, which is the reversal that we saw earlier on the weekend was not, in my mind, it was irrelevant. We've seen Bitcoin wipe out, 10-20% in a day or two and then brush it off and make new highs later that week. This is nothing new. But the one thing that I was looking for, exactly the way I described it, the bulls in Bitcoin were going to buy the dip. This was a given. You know what? All those that were suffering FOMO from the move saw it sell at a discount. There was going to be a rally, but if it didn't make a higher high, then that's the first warning that something is different. And so I don't, we'll see what the price action is over the weekend and into Monday. But if we don't
isn't that weird how you said we're going to see the price action over the weekend?
Well, a couple of people were commenting on Twitter on us is like, these old farts don't think that Bitcoin stops trading, right?
I know. It's funny. I had to tell my son that the market stops at 4:00. He kind of thought that it kept trading
because that's all the.
And they just I think all these new traders, they somehow think that trading at 8:00 is the same as trading at 4, and I'm like, or 3:30, 7:30 is the same as 3:30, and I'm like, no, you should be really careful about that. But having said that, it's increasingly getting more and more liquid. Past it is strange how the liquidity change. Okay, what's number 2? What are you watching?
For sure. But the point I wanted to just touch on there is I think that more than ever, sentiment is so important. And these are the generals that are leading the way, that are what everybody's anchoring off of. And it's creating that positive sentiment that allows that money to keep being leveraged up. When these two turn, not that I'm saying we know for sure it has, but when they do, it's going to be really important. So number 2, we have the big wave of central bank meetings, ECB, BOJ, BOC, you name it. We're up on the thing. And well, I'm going to first let you comment. What's your take?
I'm going to not change my comment, or my tune at least, which is the fact that central banks don't mean as much as everyone thinks they mean anymore.
Not anymore.
Central banks, all they can do is mess it up. They can't fix anything. So I'm hopeful that it ends up being a bunch of non-events and they don't try to do anymore. All they can do is facilitate more fiscal. And if they try to do stuff by, either easing or monkeying with it, it's just going to be a disaster in the making. So I'm hopeful. I'm hopeful it's not a non-event.
I think that there's not much left in their toolbox for monetary policy. All they're going to do is going to be about governments and fiscal, and all they can do is accommodate them. And so I think the baton is being passed, and these central bank meetings are nowhere. Remember a year or two ago when every single one of these meetings was only thing that mattered. And it seems like now that it's like no one gives a shit anymore. It's amazing how these things kind of go.
Yeah.
Anyway, number 1, post-OPEX and inauguration volatility. And obviously, we had a gamma pin going on. Actually, today, a little bit of volatility kind of ended up closing somewhat back toward its 40 points. It was a 1% move in the market. But overall, the gamma pin was kind of the typical thing we see into an expiration. And usually what happens afterwards is you get the unpinning and volatility returns. And we have an inauguration that's coming at that same time. And so do we start seeing big market moves next week is one of the things I'm watching.
Yeah, so usually on the week of expiry, you get actual decline in volatility because of the effect of that kind of pinning it more and more. But the thing about this one is that it's happening in front of the inauguration. Does this end up being something the market's worried about? I don't know. It's difficult to tell. One of the things, though, is after the OPEX, we could see a situation where volatility declines, and then we get that charm bid that Jem talked about so much, in that great interview last week about the Vanna bid in terms of the decline in volatility causes a bid to the market. Now, having said that, Patrick, you're talking about the state of the current kind of positioning from the dealers. I noted that our friend Brent from Spot Gamma, I was going through his charts today, and although the dealers are long gamma on the S&P 500, they're actually short on the NASDAQ.
Really?
Which is very unusual, yeah. It's a net short gamma position in the NASDAQ.
But the one that's just rolling off today.
Well, this morning, I didn't look at what it's going to be like on Monday. I didn't see that. But right now, they went into today short gamma on the NASDAQ and long gamma on the S&P. So if you are to look for some volatility, I think you should expect it in the NASDAQ. It's also up here in nosebleed territory.
It is interesting also to see that the S&P is not where the attention is. Like we were talking, I was reading Charlie McElligot's thing of where the call skew seems a little flatter, at least it's not nowhere at any extremes, but really where the extremes are on the cyclical value sectors, like where like energy was to like the 90th percentile in terms of the call skews. Like there's semiconductors and all these other types of spaces, emerging markets where the call skews were very, and so it's like investors are really picking the hot stocks, and that's where they're chasing with a lot of the call options. Do you have an opinion on that?
Oh no, it's I think it's interesting, and there's no doubt that there was a lot of that, but at the same time, the Nasdaq is not really where they're centering their attention, but they are centering it towards a lot of these more speculative kind of EV names and crazy stuff like that. So it's interesting because you're getting this value bid for like old economy stocks. You're seeing things like energy being bid and banks for a little while. I think Charlie highlighted how the XLF was also one of those ones that was experiencing a lot of call buyings. But at the same time, you're just getting just crazy moves in these SPACs and these EV names. So
that's where the bubble is, though.
Well, I kind of
solar
like it
stocks.
because
Did
there's
you
a lot
see
of
TAN?
opportunities. It's not just
let's talk
one
about
trade.
this. Let's talk about this because I want to pull up. Let's look at the solar stuff like TAN. Like this thing went outright parabolic off of the March low. TAN in the ETF for all the solar stocks up almost 500%.
Yeah,
just ridiculous. But look what it did in the last week. We are like 5 sustained days of selling. I mean, there was only one period in October where we saw some kind of price action like this.
I actually didn't realize today was so ugly in that square. That's a terrible looking chart.
Like, what EV name do you want to look at?
Oh, you can just pick whatever you want. Like
let's do NEO or something. Like, look at these reversals, right? Like, and this is why I'm very curious about what happened with Tesla and everything. Today, things seem to have rolled, and things were so frothy earlier in the week at going into the start of January that it's like the market was overdue for one of these. And another place that's really interesting, I want to go back to this dollar index. So let's go over here. The dollar has really, it kind of almost, what's the reverse prairie dog? Did we come up with a name for the reverse prairie dog?
No, we didn't come up with the reverse prairie dog yet. You tried porpoise, but it didn't stick. It was a terrible
or like loon dive or something. I don't know. None of them work. It just, it doesn't feel right? Like it's, any of our listeners who have a great reverse prairie dog name for us, please share. Like we are searching desperately for a name for this pattern.
We need some sort of animal.
Yes.
Yeah.
And anyway, but the dollar, one of the things that I continue to watch is when will the dollar squeeze happen? Like, forget the fundamentals on the dollar. Everyone is so goddamn convinced that the U.S. dollar is going lower, and there's fundamental reasons behind it. I don't care, and it's true, and I'm not going to fight back on that. But when everyone is crowded, everybody is stop.
That's a sign there that you're not fighting back on it. I'm worried about it. If there's ever a dollar bull argument to be had, it's the fact that Patrick has finally accepted that there's fundamentals that are going to cause the dollar to go down.
Anyway, so but when everyone is so consensus on this trade, it's setting up for a short squeeze, and the dollar downtrend has been the anchor of the reflation trade, and so many of these things, like all these resource stocks. I'm just going to pick on the ridiculous one of REMX, which is the rare earths. Like, we have seen just whether it's you take individual stocks, copper miners, you take the basic material names, iron ore plays, rare earth plays. You take them all, lithium plays. You take these resource stocks. Oh, how about the grains? Soybean. Did you see this chart? Of course you saw the chart, but like we are seeing all of these going full parabolic, and it's all anchoring off of, in my opinion, and you could push back, but it's all a part of the bigger reflation trade, and it's all on the belief that the dollar is just going to keep going down.
I don't know if it's all on the belief, but there's no doubt that it's all moving together. No
it's all
doubt
moving
about it.
together. And so,
and listen,
my
the
opinion,
dollar is vulnerable. Like, look at
if the
your
dollar
cardigan.
squeeze happens, all of these things mean revert. And everyone that's on the wrong side of that trade is going to have a puke moment here. And it doesn't mean that the big picture has to have a different outcome. All of your big picture thesis and narrative can end up being all true. And I don't even want to argue about that. I just think that we're in a moment where this air of easy money has made everyone crowded in all the same trades. And there's so much room for the rug to be pulled out from under people's feet, and we have some sort of like little mini market puke on these really hot sectors.
So we know that Patrick does not read my letter, at least not on a timely basis.
Why did you write about this?
Yes, I did today.
Oh my God! See,
I
I'm busy. I
bought Nasdaq puts and I bought Euro. Well, actually, I did it yesterday, but anyways, I bought Nasdaq puts and I bought Euro dollar puts.
Well, there you go. We've been holding on to that calendared straddle that will have a big picture. So we're at 380 on the strike of the SPY. So let's see what happens.
I think you're. By the way, I think. Well, anyways, you know what? We'll leave it at that. I couldn't agree with more. I think that we are due for something, and that the dollar will be a key factor in it. Yeah. But I actually think there's one currency in particular. And when you go through the reasoning and you look at the positioning, it becomes very clear to me where you should be concentrating on your efforts.
All right. Anyway, that's enough for talking charts. Let's move on.
Okay, Patrick, it's time for This Week in Trading History. What do you got for us?
Well, you know what? Short and sweet. It was January 13th, 1932. The Fed announces an anti-deflation campaign.
Oh, so did not know that.
Yeah.
Anti-deflation.
Yeah, and so, there's that great book, Lords of Finance, that was written about all of the monetary policy through the 1920s and 30s that kind of covers all of these different things. It's really good if you want to read deeper into it. But, obviously, many argue that the Fed induced the Depression. With their monetary policy. And it was in 1932, several years later, where they started to try to use monetary policy to fight deflation and get everything going. What's interesting about this, the moment it was announced, the Dow Jones jumped over 6%, 6.25% on that day, making it at the time the sixth biggest up day that the stock market ever had at that time.
That's actually fascinating because a lot of people think, oh, this is a new phenomena that the Fed's moving markets. And this is like we're so focused on central banks today. And yet, look at that. What is that? 90 years ago, it was the same deal.
Exactly. And so they enacted that anti-deflation campaign and created an easy credit policy. But despite that jump and the positive news, it was a little early. If you notice that little arrow on that chart showing there, the stock market still ended up dropping. At the time, it was down 75% from its highs. Everyone would think it's cheap, but then it proceeds to drop another 50%. From that level.
Come on, really?
I dropped another 50% and didn't bottom until July 8th of 1932. So, and you know what it reminds me a lot of is when in 2008, when there was the big bailout of the banks in October, where the stock market still kept going down for another 6 months before it bottomed in March of 2009. And I think it's a very similar thing. It was a big event, but the bear market was just too entrenched, and the damage kept coming. But this was the not first attempt, but it was definitely the Fed trying to intervene and finally turn the tide of that depression and deflation that was going on through that period. Anyway, that's it. That's my history for the day.
I like it. Thanks for sharing with us today, Patrick.
All right. Time for No Stupid Questions. Lena, jump on.
Hello.
So, Lena.
Yes.
What's the first question?
So this week's first question, it's a two-part question because, well, maybe not two-part, but this listener has given us an update based on his first question. So here it goes. Hi guys, love the show. So after listening to Cuppy's method of targeting Dillards for a short squeeze, I decided to plug in the same criteria, high percentage of float held short, net insider accumulation, and high borrowing cost into my screener and came up with GameStop. Then I felt smart because I downloaded Cuppy's KDM and found GME at the top of his short sale list. So here it is on Monday, and the squeeze seems to be underway. My question is, if days to cover is listed as 7, does days to cover assume that all shorts are covering? And if so, what percentage of shorts usually covers? I'm trying to figure out how many days to realistically hold on to a short squeeze without getting bogged down in technical charts. Thanks. Then this listener also sent in an update. Hi guys, GME went gangbusters. So regardless of what the answer to my question is, I got out today. Timing could have been better, but maybe the day it goes gangbusters is the answer to my question. How many days should I hold a short squeeze based on days to cover?
All right, so here's the chart.
Listen, well done, first of all, to this listener. Great job in terms of trading this. And that is one of a Cuppy play. I know he's actually been in this one numerous times. It's been unbelievable, this thing. I think that, Patrick, I don't know how they managed it, but there is more shorts outstanding than float and even total shares outstanding. I don't get it. I don't know if Bloomberg's wrong or whatever.
It's called mathemagics.
Because you're not allowed to short unless you have a borrow in the States. You need positive affirmation of borrow. So theoretically, they should never be allowed to do this. But anyways, so it's happened. Listen, there is no answer in terms of like a certain number of days. And yes, you are correct that the days to cover is as a percentage of the average trading. And so it kind of shows that as an approximation of how many days if everyone decided to cover. But that's never going to happen. And you don't even know why people are short. There's lots of things. It could be somebody has some options that they've monetized through, a grant, and they've gone to their local derivatives group and they've gone and monetized long-term options. Or there could be convertible bonds that never go, and that short won't get covered until the actual convertible matures. Or it could be option guys. So there is no real answer to the question except to say that this is just there to highlight that there's a potential for a squeeze. And once that squeeze happens, just like, you did a great job trading it, once it gets there, you just actually have to let your own rules take over, and there is no kind of quantitative way of getting out.
All right. Lena, question 2.
So question number 2. I've learned over the years that I need a strong process to perform at my best. Whether it be trading, playing golf, or drinking, I need a defined, clear-cut process to follow. For example, pouring the perfect brandy and Coke. Rule number 1, glass type, short glass only. Rule number 2, ice, full glass with ice. Rule number 3, brandy to Coke ratio, 1/3 brandy, 2/3 Coke. Rule 4, repeat.
And repeat, right?
Exactly. When trading, I have rules for entering trades, exiting trades that aren't working, turning working trades into free trades, etc. But I can't seem to find a rule that suits me for taking profits. What are your own profit-taking rules? And for someone like me that prefers to complete a strict process then move on to the next trade, are there any black and white rules I could follow?
Well, profit taking is one of the single most important exercises, right? And so, Kev, when someone takes the Technical Masters program at Big Picture or something like that, what I always say is that almost everyone takes the course because they want me to show them when to buy a stock, but what they learn by the end of the course is that it's not when you bought it, but when you sold it that actually determines whether you're any good at this. So it's really interesting that this listener question. It's so true. The true success in trading is how you manage the trade after you're in. And so you have to have some sort of set of rules, and there are no shortage of techniques. Some of the most basic ones are technical techniques like using a parabolic SAR or any.
Is that like a Russian oligarch? What is it?
Yeah. Stop and reverse. It's just
SAR.
It's
I thought it was CZAR. Sorry. I'm not very good at all these technical stuff.
It's technical, but some people like to use trailing stops and moving averages. There's all sorts of techniques. I tend to use rules of symmetry and other things like this to kind of determine when a move has gotten very mature and when it is, and you have to know how to protect that profit. I use options to lock in. Like I love the risk reversal or collar strategy when a stock gets very mature. You want to give it some more upside, but you also want to lock in the gains. There's all sorts of really neat ways, but the key is to have a way of doing it, right? Like too many people wing it, and I think the biggest obstacle for most people is that once they have seen the paper profit and they saw like one moment I was up $10,000 and then the next day you see that I'm only up $9,000, they can't, because they've seen $10,000 on their screen, they feel like they lost $1,000. And that paper profit psychologically messes them up, and then they get unanchored and they lose their ability to take the profit. It's like the strangest psychology we deal with, right?
You were talking about trades becoming mature. I like to wait till they move from beer into wine, and then that's when I decide that the trade should come off.
All right,
they're mature.
All right,
and that's why we're
your...
still going, because we're still on the beer and we haven't matured into wine.
All right.
Yet.
One last question, Lena. One last question.
So last question this week. Hello, gentlemen. Big Picture Trading member here with a very important question. So Warren Buffett called Bitcoin rat poison squared.
Sorry.
I
wish I had come up with that.
This has
I didn't even hear that until this listener. Anyway.
Yeah.
Okay.
Anyway, this has internal consistency as he has an aversion to gold and any other asset that does not produce income or dividends. On the other hand, Patrick, you have fallen head over heels in love with gold. It is a shiny rock that just sits there, pretty. My wedding ring is made of gold, but still produces nothing. Then there is Bitcoin, which is 5% the market cap of gold and is simply better at doing the gold thing than gold. So why the double standard? What would it take for you to go from being a no-coiner to recognizing that you're already shill on one shitcoin, gold? And that if you are going to back gold, you might as well swim in the techno version of gold. You appear just as much religious anti-Bitcoin zealot as the Bitcoin fanatics are. I love the show, love being a Big Picture member. I'm just curious at your aversion.
Can I take that? Because I would say I'm more of a anti-coiner than Patrick.
Okay, do it.
Conceptually, this listener is bang on correct. The gold, when you actually think about it, its value, from a utility perspective, is much, much lower. Like if all of a sudden there was no demand for gold from a kind of purchasing power or protecting your wealth perspective, gold would fall. It would fall to the point where it would be competing with silver and other assets for use in industrial metals. So I can't disagree with the logic that that one of your members is providing. Now, having said that, gold has been around for a millennium in terms of a kind of a protection of your purchasing power. Thousands and thousands and thousands of years it's been around. What's that thing about one 1 ounce of gold will buy you a good suit or something? And if you look at it through time, it's worked out. It makes a lot of sense from that perspective that there's a lot of history in it. And if you believe that this time is different and something's going to displace gold and that's going to be these bits in the sky, then great, go for it. I could be wrong. I could be sitting around holding my shiny relic that nobody wants. Having said that, those bits in the sky are just that. They're just bits. There's actually nothing physical about them, whereas gold ultimately is a commodity that has unique properties, and although it might be overvalued from a utilitarian point of view, there is a certain amount of it, and I'm not worried about the network getting pulled down and I'm losing my gold. And that's ultimately why I think that gold is a much better store of value than Bitcoin. Do you have anything to add, Patrick?
I'm just going to shut up.
Yeah, we're just gonna get in trouble with all the big and stuff like that. And the one thing I will say is I'm kind of confused about Bitcoin in terms of when I look at the actual technology that it purports to be kind of pushing on the whole world, and then I go and look at it and I realize that there's much better products out there like BSV. in terms of actually doing what people are so excited about Bitcoin doing, and yet they're not interested in that. They're interested in Bitcoin. I really get the feeling it's going up because it's going up. Yes, I understand the network effect. Yes, I understand that there needs to be something to get you in there. But I am just really concerned that ultimately it's like you're investing in Betamax.
All right, Lena. If people want to rebut, just ask you questions, feel free to tell them where.
Listen,
they can,
you know
find
what?
us.
They have the ultimate rebuttal because they're making all sorts of money, and I'm having fun staying poor.
Yeah, you're staying poor, buddy.
I have to tell you one quick question. You're gonna laugh. So somebody tweeted this, have fun staying poor, the HSFP, right? I get it all the time. But I get your other partner that you cheat on me with. He doesn't get it as often, and he got it along with me on somebody tagged him, and he sent me a thing saying, "What the hell is this?" I was like, "Oh, it's have fun staying poor."
That's
so
funny.
he had no clue about it. So I enlightened him.
Oh, there you go. All right.
So if you have any questions for Kevin and Patrick, please submit your questions to nostupidquestions@markethuddle.com.
All right.
Okay, great. Now it's time for Skin in the Game. And I finally won one. I got that monkey off my back.
Yeah, it was a pretty bad losing streak.
It
What
was.
was it,
It
like
was.
3 or
I'm
4?
not going to deny it. I actually was
Three or
really
three or
worried
four?
about it. I was worried about it. There's no doubt about it. I started strong, and then I just I hit a lull. And the really bad part about it was that you got me, and that was really what bothered me the most, was that you figured out my vulnerabilities and you took advantage of them. So good for you. Good for you, but I feel like I could have done better.
I think you're giving me more credit than I deserve.
No,
but okay.
you picked names that you knew.
Yeah,
that I
you
had
still.
weakness.
All right.
No,
All
you
right. So
picked
you want revenge. You're out for blood. You're out for blood.
If you had gone and just picked names that I was indifferent to, I probably would have made a much better choice. So hats off to you. I respect it.
So let's just let everyone know. So what our bet was this week: Bitcoin one touch 50,000 by the Friday of the time of recording this episode. We're nowhere near there. I didn't really say it will. You just said it wouldn't. So I had to take the other side of trade. And so you won.
All right, finally got one. It's almost like you gave me that one. It felt like too easy. Although
no, you know what? I
Bitcoin
actually
was
thought,
very volatile. So at the time,
I honestly thought I picked a level that legitimately had a 50-50 chance of being hit.
So let me tell people about our game. Our Skin in the Game is a weekly opportunity for us to demonstrate that we are degenerate gamblers at heart. Every week, one of us presents a wager, and the other guy chooses which side of the bet he wants. Every wager needs to settle by next episode, and the currency for the wagers is as follows: a Duke and Duke, which is a crisp American dollar bill, a pint of beer, a burger bet, a pitcher, a case of beer, which is a 2-4 here in Canada, a bottle of wine with a $100 limit, and a steak dinner. We still haven't got the steak dinner. I'm really upset about this.
We're going to find a bet. We're going to find a bet.
The winner of the bet is obligated to create a new bet for the following week, and all wagers settle in full, and there will be no netting of positions. Okay, so it's my turn.
Yes.
So realizing what you did to me, I decided to do the same to you.
Okay.
So we're going to do the U.S. 10-year yield.
Okay.
And I don't know, what is your, you use a different system. I use a Bloomberg. What do you have? What did your 10-year
I'm trading via here. I'll put the 10-year yield.
I just want to make sure when I get my level here that we're on the same. By the way, we do not tell each other the things in advance.
Yeah,
so Patrick has no idea what I'm going to do.
So 1 week on the 10-year yield.
Yeah, but what is the 10-year right? What do you have for 10-year?
1.087.
Yeah, see, yours is different than mine. Mine's 1.0835. Okay, so are we going to use yours or mine? Because I'm going to adjust it depending on whose we use.
Let's use this because that way we can get onto the trading view.
Okay, so here we go. One touch, 85 basis points.
Wow. That's crazy. No. It won't.
Okay. So I have.
You know what? No. You know what? This is a good bet. It won't do it. It won't do it. because there's going to be volatility next week, but that you're talking about a move that would make a 1 month low in a week. It's possible, but it's too good for me to not take the other side of that bet. I'm willing to go. How high do you want to go on this one?
Oh, I don't want to go that high. You know I'm the other way. I don't like bonds. So
all right, so no steak dinner?
We're
backing?
We'll do a pitcher.
What?
I like the pitchers because we want to get the pitchers higher for when the COVID's over and we finally have the Market Huddle meetup.
Well, we're going to need like 50 listeners to show up at the pace we're pitching out these.
Yeah. So you're going to do a pitcher? Are you on for a pitcher?
Yeah, I'm definitely on.
Okay, so a pitcher it is. And so just, Lena,
One
just so you know,
touch
it's 85 basis points, one touch. I'm in the unusual camp of betting, hoping for bonds.
Well, yeah. Anyway, all right. We got to close the show now, right?
Yeah, I guess we got to do something like that. Okay, so thanks for tuning into the Market Huddle. We appreciate you spending some time with us. Please give us a follow at the Market Huddle on Twitter. Give Lena a shout out. Find out how her dogs are doing. I know she would love to hear about your experiences. By the way, actually, I wanted to say something quickly. One of my readers and your subscribers and good friend of the Huddle, he actually sent me something showing me that he has a schnoodle. Same dog as what Lena is creating, or I don't know what you say.
All right, well, let's talk about this.
We'll talk about this after. Anyways, you can listen to the Market Huddle on all networks: Google let's try that again. Google Podcasts, Podbean, Spotify, Android Play, iTunes, and YouTube. A lot of people watch on YouTube to see all of our charts and visuals. And while you're there, please like and subscribe. Smash that like button, I heard is what you're supposed to say. And please, if you could, rate us and review us on iTunes. It helps us out. Patrick, where can they find you?
You can find me on Twitter at Patrick Ceresna and as well at bigpicturetrading.com. Kevin, where can they find you?
I'm at Kevin Muir on Twitter, and you can check out my newsletter at themacrotourist.com. And listen, we can never have too many friends. Bear market, bull market, we're just happy to spend some time together on this crazy ride. So thanks for tuning in. Now stick around for the after show.
Nice.
Lena.
All right.
Well, let's do the beer before we talk dogs.
Oh, right. Yeah, let's do the beer.
Okay, so I you know what I realized? I'm not very fair to beer kind of companies because I don't rate them based upon the actual example of the type of beer that they're creating. So I don't like those coffee stouts or whatever or a sour. So I always just give a shitty rating because I don't like those beers.
Right.
So it's not really fair. I almost feel like I should be adjusting it for my own dislike of different beers. Because these guys, I thought the last beer was awful. And this beer is really great. So obviously these guys know what they're doing. I just don't know how to actually rate the kind of different types of beers. So I'm giving this a good solid 8.4, good quality beer. I really enjoyed it.
How about you, Lena?
I am almost finished, so I like this beer very much. So I would probably give it an 8.9.
Oh my God, Lena's higher.
Wow.
Nice. What did you like about it so much?
I could listen to you guys. That's about it the whole time.
Oh, you mean
But,
the
no,
fact
I'm
that
just
you
kidding.
actually made us listenable is why you enjoyed it.
No, I'm kidding. But it's no, it was good. I drank it in no time, and it was very smooth. I could probably drink a few of these.
Yeah,
sure.
I liked it. I'm about fire. Thank you very much, Andy. I appreciated this one.
Yeah, thank you.
Well, I don't know what we'll do with the other ones,
Yeah.
but we'll figure something out.
I'm going to have to just have the same rating on my...
yeah, you're just going to be like that all the time you're in Barbados.
Yeah, the whole time I'm down here, I'm just going to be rating the Banks Caribbean Lager here, and it's still the 7.5.
You know what?
easy
You'll
light
probably change it
rating.
depending on how drunk you are. You'll be like, oh, it's great. It's better this time. It's 8.5. Okay, so first of all, we need an update on the puppies.
Oh, yeah. She's, so my dog Harley, she's a toy poodle or miniature poodle. She is pregnant and she is due between today and tomorrow.
Oh.
And she's downstairs right now, just resting in her whelping box, I guess they call it.
Yeah.
And she's panting a bit, but she's okay. And I think we're gonna see the puppies within the next 24 hours.
You got to talk to her. She did not plan this very well with you having to cut a show still.
Yeah.
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 Lena, you should have done some backwards calendar math to when.
Well,
when you
she
got-
is
anyway.
supposed to be due tomorrow.
Backwards calendar math.
Yeah.
He should have figured out exactly
Yeah,
what days.
exactly.
It should never interfere with the huddle. Like this is it's a bad
No,
math.
we completely understand.
No, I'm
we
just
hope
kidding.
that your
Yeah.
puppies are good. Do you know how many you're getting?
Yeah.
Have you actually gone and like done an ultrasound?
Yeah. So we went to go see the vet a couple of weeks ago just to check how she's doing and how many puppies we'll be getting. And the vet said it's not entirely exact science, but he said it's 4 puppies. So
It's
we'll
not
have
exact. So wait, how is it not
not
exact
3, not
science?
5.
Like,
but
Well, I
4
think
sounds
because-
pretty
I
extra
don't
exact.
know
there.
if it's like
That makes no sense. Did they
the
do an ultrasound?
I think because she's so small, I don't know if they could see everything clearly or not. So, but they said it was 4
not
puppies. I
exact
don't know.
science.
Maybe I have to go to a different vet. I don't know.
So if you have like 22, you're going to be surprised.
Oh, very much. Yes. We read that the biggest litter from the same breed, I think, was like 12 or something. Like
Oh my
that.
God.
So
12.
What?
or something like ridiculous.
So you're
I'm
taking
happy
one.
that's
Your
a
friend
score.
that they had the schnauzer is taking one. What are you doing with the rest of them?
Our parents.
Oh really?
Yeah.
Oh, this is a family affair.
All in the family.
This
Yeah,
is like
all in the
there's
family.
at least that's what you're saying here on air. Meanwhile, anybody that's interested in a schnoodle, please send us a note.
Yeah, if
Message
you're in
us at the
if you're in
Market Huddle on
GTA
Twitter.
area, if you're in the GTA, please shoot me a
That's
message
right.
if you want to schnoodle.
On the cheap, only
Yeah, they'll
payable
be
in
ready
Bitcoin.
March.
Bitcoin. 0.25 bitcoins
That's
for a
right.
schnoodle.
That's right.
Okay, so I have a new show for you guys.
All right.
It's louder. What is it? Louder.
Oh, louder milk?
Yeah. Did you go watch it, Lena?
No, but I did go watch The Undoing. I wanted to watch that first
Wait, The Undoing.
with Nicole.
Oh, that was the one I told you about. That I like that
Yes.
one. What do you think?
Oh, it was so good.
Yeah, it was pretty good. I liked it. I
Oh,
liked
it
it.
was
I
good.
wouldn't. I like louder milk better, but Undoing was pretty good. Yeah.
Yeah, like it was really good.
Yeah.
I don't usually watch things with Hugh Grant in it, but he was bearable. in this one.
You're vehemently opposed to Hugh Grant. Why is that?
I don't know. He just rubs me off the wrong way. I can't. I don't know why, but I just.
He rubs a
can't
lot
watch
of
movies
people
with
the
him.
wrong way, including.
I think I know what you're talking about. But,
Oh my God.
he's like my male version of Hilary Swank because I won't watch movies with Hilary Swank in it.
Oh,
Even though she's an amazing actress, I just can't.
you just don't like her. She just bothers you. You just
Yeah, I
want-
don't know what it is. I don't know what it is. So,
Yeah, I understand that. I get it.
and I watched Bridgerton. So.
Oh, you did? Did you finish the whole thing?
It was all right.
Yeah, I thought it was pretty good. It's no louder milk though.
I gotta check
we
that
got to
out
go
this week.
louder milk. Louder milk is the show I've been the most excited about in the longest time. And what's great?
Really?
Oh yeah. And what's great is there's 3 seasons. I'm not even finished the first one, and I love it.
Fantastic.
Yeah, it's so good. It's so good. I
You
don't
know
want
what
to get
else
it too
you have to
excited.
watch,
92 tomatoes though. Just like people, this is one that the market's priced right.
Are you a Bryan Cranston fan?
Like he's the Breaking Bad guy, right?
Yeah. Did you like him in Breaking Bad?
Oh, well, Breaking Bad is an all-time greatest show. Like, there's no doubt
you
about
like
it.
that? You gotta go watch Your Honor.
Oh yeah, I don't
Yeah.
know that one.
It's on HBO, I think. It's on HBO. I'm pretty sure.
Yeah, they spelled honor wrong, but otherwise it looks good.
Yeah, it's Your Honor, and it's good. You gotta watch it.
And is this new?
I think so. I just saw it.
Oh, like is this like a drama?
Yeah, it's pretty heavy.
Oh, good. You know what? I was looking for. My wife doesn't like comedies like Louder Mouth, so I have to watch that one alone. But literally, she goes off for a walk with her friends, and I watch Louder Milk, and I binges like 2 hours of Louder Milk. I love it. It's so
There
good.
you go.
Lena. I can't wait to hear what you guys think because you guys are fans of that kind of stuff.
Yeah.
Yeah, okay.
Okay, I'm gonna try Your Honor. So this is what on HBO.
Yeah.
Okay, I'm trying this. You know what? I'm gonna go tonight with this. Patrick, what are you doing? Give us an update on Barbados.
Yeah,
First of
you
all,
can?
are you allowed? Did you get rid of the
Yeah,
$600 a day
Yeah.
shakedown?
Yeah. I'm
They
free
decided
man.
that they
It's,
decided they shaken you down for enough, and that they could send them on their way.
Oh yeah.
I hate to tell you this, but you know that they had the test back the next day, right? Like for sure. For those who don't know, Patrick went to the Barbados they told him that the test was delayed. But and he would have to stay. He had a choice of staying in a government like hotel or whatever, or he could go to his house, but he had to pay for the $600 a day guard. Patrick, like a fool, says, "Sure, that's great." And then they decide. They say
7 days later.
7 days later, and for sure the second day they had it, and they're like, "Oh, Fred needs work. Let's just tell this guy that They just basically just did it till the next fool came. And that's when it came, right? Like when the next guy ordered it, they're like, okay, now we can move it to this next guy.
That's so funny.
There's a sucker born every minute.
They're very smart. Anyway, so you got rid of the guard, and now you're good. You're allowed to go around the island. How is it? What's it like?
Well, they have a quarantine. Sorry, a curfew and stuff over here, but it's really nice going swimming in the ocean, and anyway, it's all good. Having a great time.
Hey, at least you can go explore the island. Where people in Toronto were.
Yeah, we're under lockdown.
Yeah.
Yeah, it's pretty harsh. Yeah.
Yeah.
Oh,
I heard people are getting pulled over and asked where they're going and stuff. Did you hear that, Lena?
Yeah, I heard that too. It's getting pretty strict, and Luke came back from Barbados yesterday.
Yeah.
So now he's in 14-day quarantine, and I have to be in the quarantine with him by association, basically.
Yeah.
So. Yeah.
So like if your dogs have problems, what are you gonna do? You're just gonna like push her out on the front door and hope someone comes by and picks her up?
Hopefully nothing will go
I know,
wrong,
touch wood. Let's everyone, all of our listeners, pray for Lena's dogs.
I mean, I have like different emergency animal hospitals, on speed dial right now, just in case. But the vet assured me that 99% of the time things will go smoothly, and
Does the dog know what it's doing? Like you don't need to get involved at all?
Yeah, they said she'll just like the instincts will just kick in, so
nice.
She'll know what to do, and that I'm just literally there for like emotional support, and in case there's an emergency of any kind, that I can just step in.
So you're just like the men at like a birthday. I got to tell a story about this about the men. Okay, so just imagine this: I'm 28 years old, or am I 29? No, I'm 20 years old. My wife is pregnant. I've been working on the main desk at RBC on the institutional equity derivatives desk. So I'm there, and I'm a young guy. The wife's gonna have her first kid, and this older guy takes me aside and goes, "Listen, there's really only two things you need to know about your wife having a kid." He goes, "The first is the drug man. That doctor with the drugs, that is really your only job, is to make sure that at the right moment he's there and you're able to put the epidural in. Because if you miss the point where you can't put in the epidural, you're fucked, and therefore you're screwed. And so your job is to know where that drug man is at all times. If he goes off the floor, you follow him. You just make sure you know where he is. You don't let him go anywhere. You make sure that you get that epidural." And then he says, "Okay, so now that you got that, then you can have the second one." And he says the second most important thing to remember is there's going to be a period after a lot of screaming, and it's going to be a moment of silence, and it's going to be awkward, and you're going to think a joke would go really well in there. It doesn't. That was it. So that's what I give. That's the advice I give all young people. Or young men.
There you go.
That's all you got to know.
It sounds
know
pretty
the drug
good to
man,
me.
and just that the reality is that the joke is not going to go well. Keep it inside.
That's hilarious.
It's only funny in your head.
Yeah, keep it in your head. Well,
all right.
Okay, well, Patrick, have a great time, you bum.
Yeah.
Everyone's jealous.
To be continued. I'm working. I'm working
bullshit.
really, really hard out here.
Yeah.
It's
you got the whole weekend is hanging around. We're going to be huddled. Lena's going to be busy wiping off like slimy puppies. I'm going to have nothing to do. Like I'm going to be huddled, basically quarantined in my house. And you're going to be going to the beach and enjoying the nice weather.
All right, don't make me jealous. No.
Anyways, enjoy yourself. Lena, best of luck with your puppies, like all kidding aside.
Yeah, good luck. Congratulations.
I hope it goes well. And honestly, you know what? If something happens, don't worry about the show. Everyone will understand. Make it late. Like, honestly, don't worry about it at all.
I'm sure it'll be fine.
Yeah. But if it's not, honestly, like really, and I'm just saying that, do not rush the show through or whatever. The puppies are more important.
Yeah.
Yeah.
All
We
right.
don't wanna
Anyway,
have any puppy
we'll
deaths on our hands.
Yeah.
Anyways, best of luck. I hope everything goes well.
Okay, take care.
Okay, bye-bye.
Have a good weekend.
Bye-bye. Good night.